There is a case for profit taking, consolidation. A little bit of a downtake will not hurt anybody at this stage. But if we get a weak jobs data later today, Monday could see, of course, that would mean that there'd been increased chances of a rate cut coming in from the Federal Reserve in September. And if that gets priced in, then you will see a markets catch up with global equity markets. And if that happens, it's a double leg up for pharma and IT. Of course, IT also reports earnings on Wednesday, so that rally may be short-lived, but sentimentally, you may see IT and pharma provide that support for the next leg up on the markets. But as we see it in isolation today, the Nifty is looking like it could spend some time consolidating at these levels. 24,000 is a very critical level of support, and on the upside, 24,556 becomes an important level of resistance. But let's not forget, we've had a pretty solid month. The Nifty is up 7.5% for the month. Year to date, if you want to pull that up too while we're at it, the last time I checked, we were up by about 12%. So the Nifty is not done too badly, and it'd be interesting to see what funds are getting up to. But for now, it's banking that's led the way, which may be on the sell side today. We'll talk about HDFC because that's largely been the reason the markets have gone up or down this week. Early this week, with its increase in weightage of FI holding in HDFC Bank, we saw a good move on the stock. But preempting that, the stock had made a record high, remember, and that led to the Bank Nifty doing quite well. But what we've seen in the last few days is it's ICICI Bank that's been doing better than HDFC Bank, at least in stock performance. And we know why now. Q1 numbers in terms of business updates from HDFC Bank are very disappointing, to say the least. Remember, the first quarter is seasonally a weak quarter, but this reporting that has come in is even worse than what we were expecting. Just to take you through that, their gross advances are down 0.8%, deposits are flat, CASA is also down 5%. This excludes the HDFC Limited loans. The pain point for HDFC Bank remains wholesale and retail, which has seen a degrowth. So corporate lending and retail continues to be a weak spot for HDFC Bank in this quarter as well. Rural, though, on the other hand, was slightly better, but there's no significant outperformance expected on the count. And this is what Nomura is saying, right, given the current market price. So it seems well priced at these levels. Some pressure can be expected on the stock. We want to just see what happened on the ADR. That should also give you a sense of what, okay, I believe we don't have it, but I'm assuming it would have been a weak morning. The stock was also down 2.5% yesterday. PNB, on the other hand,
I thought I thought the Nomura note summed it up really well, Samina, because if you bring up what Nomura has to say for HDFC Bank, one, they say that the loan and deposit growth are tracking below the FY25 estimates that at least they have and presumably other brokerages have. So that's part one of the argument. Two, they say that while the balance sheet course correction is underway and everybody knows about it, the progress is very, very gradual. And I think the most important part, at the same result at 1450, HDFC Bank may not have been, let's say, people may not have been as shocked or whatever it is, because the valuation picture at 1750 is way different from the valuation picture at 1450, and I think that's the point they make, that they do not see a case for significant outperformance versus other private banks. And which is why I think Samina was saying that if you look at the last 2 days as well, despite the news of MSCI, ICICI Bank has outperformed HDFC Bank, which means people are not going out and blindly buying HDFC Bank the way they were at 1400 or 1450.
But I think, Neeraj, just on that, when we went from 1450 to 1700, it was not on back of a sudden turnaround.
No, valuations.
With the valuation, exactly. So I don't know, while these numbers are disappointing, they should not lead to a heavy sell-off, because at the end of the day, it's well priced. At 1750, I think it's factoring in a weak quarter, a seasonally weak quarter. This might be slightly worse off, but I don't think there was anybody on the street who was expecting corporate and retail banking to come back with a bang, rural growth to see a huge jump up, NIMs to improve. I had not heard any of those expectations. Brokerages were constructive because of valuations. Markets rewarded the stock just a little bit in the last few days on back of the FI holding position. None of it had to do with fundamentals. And even I think the alt analyst we spoke to said, I'm not even looking at fundamentals.
Yeah,
this is simply to do with the charts, with the fact that FI numbers are going to go up. So fundamentally, nothing's changed. It still looks like a bank that is trying to find its way. Of course, if these numbers were great, we'd have seen a massive uptick on the stock on the flip, I'd imagine.
That too. But also, a downside will be cushioned because of the fact that there is a technical trigger of the passive rebalancing happening in August. So flows will kind of take it higher as well.
I think 1650, 1700 is going to be the sort of opening we should be eyeing on HDFC Bank.
Yeah.
But while they had a disappointing one, it wasn't too bad actually for the likes of PNB and IDBI. PNB's global business has seen a pretty significant jump of 10%. Their global deposits have grown 8.5%. Global advances are up 12%, 12.7%. And their domestic deposits have also grown 8%. So I think that's comforting. PNB's actually had a better quarter, and maybe looks even better because of how soft it's been for HDFC Bank. IDBI, on the other hand, their total business is up 15% YOY to 4.7 lakh crores. Total deposits are up 13%. CASA deposits have increased 5% as well, and net advances are up 17%. So if there's got to be a bank, then we see a little bit of an outperformance this morning. It could be IDBI Bank. But remember, banks as a pack will and may more than likely be on the sell side in today's day of trade. Another quick one I want to mention is Solar Industries. This one, we've been doing the guesswork over the last few days, trying to understand why the kind of participation we've seen in Solar Industries. That's what it's done for 1 month, 36%, just like any other defense stock. But in the last week, if we can pull up the 5-day returns in Solar Industries, it will give you an idea of why the stock was making so much of noise. But it's up 25% in the last 5 trading days. And the reason being, the company's step down has acquired 74% stake in South Africa's ProBlast. So this is an acquisition. We will connect with the management to understand what this means for Solar Industries. But what it has meant for the stock is a sharp rally and the counter crossing that 1 lakh crore rupee market cap. Another one, order wins is usually when stocks react, and this one is on Ahluwalia Contracts. They won an order to the tune of 572 crores from airport authorities of India, of Bihar, and that could be one reason you will see a gap up on Ahluwalia Contracts. So bad day for private sector banks, bad day for HDFC, but good day potentially for Pharma. If there's some cushioning coming in, Pharma may see some follow-on buying, and maybe IT as well, I'd imagine.
Yeah, it could be interesting to see what some of those do.
Oh, and Tata Motors should be the stock of the morning, I'd imagine.
Yeah, I had some thoughts there too, but just before we get to that, some stocks that I wanted to highlight. I thought ESF SFB, small stock, but the numbers look good because on a day or in a period when CASA ratios are getting questioned about the falls, even Bandhan had a weak CASA yesterday. ESF SFB, gross advance is up 30%, deposits up 33.4%, and the CASA ratio for ESF is at 23.59 versus 18.22 quarter on quarter. You look at across, right? You look at RBL Bank, you look at PNB, you look at UCO, you look at Ujjivan. Everybody has got a CASA number which is dipped quarter on quarter. Nothing alarming in a lot of those, but ESF's SFB has had really good CASA performance, so watch out for that one. Ujjivan was okay too. Total deposits up 22%, gross loan ratio up, loan book up 19%. So those are impressive numbers. CASA flattish on that base, but down about 100 bips if you will, or 90 bips if you will, at 25.6 versus 26.5% quarter on quarter. So that's the other one. And then multiple other quarterly updates. But I thought non-quarterly updates, I thought Mahindra Life was an interesting one that they made an announcement. They selected as a preferred bidder for a redevelopment project of 7 residential societies in Mumbai. The project has an estimated GDV of 1800 crores. That's a large GDV in Mumbai, Mahindra Life. Watch out for this one. It could be an interesting one for the morning seminar.
I'm just going to add 2 more to that list before.
I have 2 more too, but yeah.
Okay, you want to go first?
No, first,
okay.
please, after you.
So CG Power and Industrial Solutions, watch out for this one. They've entered into a development agreement with Skybound Realty, which is a SK Raheja group, for a joint development of property CJ House in Mumbai. So watch out for this counter. Lloyd's as well was buzzing in trade yesterday. It was one of the few lone metal gainers in the session. They've launched their QIP with a floor price of 732 crores. And IRCON could also be one that you may see a little bit of traction in today's day of trade. They've received an LOA for work of design, supply, installation, testing and commissioning of track and supply of ballast and installation of tracks in Uttarakhand from RVNL. So IRCON could be another one. IRCON on my list, Mahindra Lifespace on yours, CG Power and Lloyds to add to that second list.
Yeah, Raymond, because well discovered, but the demerger has finally happened. Watch out for that. 1:1, remember, is the ratio of viewers. So for every one share that if you held in Raymond, then you get one share of Raymond Realty. But the stock has rallied so much ahead of that, so keep that in mind. And some details that I picked up from a story on the European tariffs on Chinese EVs and question whether it's advantage Tata Motors or no. Then the reason is this. Now, 1 in 5 EVs sold in the EU in last year were made in China. And these were made by a Tesla, a Renault, a BMW. Made in China, sold in EU. Now, because the Chinese EV infrastructure very solid, EU a ready market, these brands are well recognized, dealerships are there, it was very easy. Now that the tariffs have been put in, does it append the whole structure that a Tesla, BMW, Renault or anybody else had? And therefore, to the point that Samina made, why Tata Motors could again be a stock to focus on today is because is it advantage Tata Motors, which didn't take advantage of it in the same way that some of the others have, and could JLR come into the picture in a bigger way than what it has in the EU region? I think that's a question that maybe the answers are not known as yet, but it could be very interesting because this study suggested that most cars made in China post tariffs will become more expensive than the Europe produced equivalents. And that is where I think JLR's picture comes to the fray. So because when this news came in yesterday, Tata Motors has rallied about 2.5%. Let's see if there is more in store.
Yeah, it was about 2.5% literally in the last 5 minutes of trade. And all this in context because last week it was when they announced that they would be going global and they were going to compete with the likes of Tesla because their price advantage, or rather cost advantage, and would be making their entry into the world. So big journey from the days of Land Rover, which is over a decade ago.
But
just one quick one, Neeraj, that I just want to highlight. You've also got, I don't know whether we noticed or our viewers noticed that there was a little bit of action in restaurant brands Asia. It, for some reason, was gaining yesterday, and I couldn't fathom and understand what was happening. But HDFC Mutual Fund has bought 0.9% stake in the company in an average price of 110. So it was fund action, but worth noting because when a big hand comes in, you see counters like these move quite well.
Most certainly. Okay. So, well, that's the long and short. There are enough brokerage notes, Goldman on pipes, etc., etc. But it's time to focus on the editor's cut. And Agam, we speak about two of the biggest weightages, if you will, in market parlance today.
That's exactly what I was going to, introduce both our topics with, two big themes in our markets. Of course, the first one is India's largest bank. And the second one is perhaps one of India's largest exporting sectors. These are the two aspects we're talking about. Firstly, of course, HDFC Bank. And then we're also going to talk about information technology, the kind of trends that we can expect going into the new earnings season. Of course, we'll start having, all your earnings coming through over the course of the next week. But starting off with the HDFC, yet another surprise, this time again, not necessarily towards the positive issue.
Right, Agam. So, the whole newsroom came to me at one point in time, day before yesterday, and everybody had this question: what exactly is happening at HDFC Bank? Are we likely to see a very strong Q1? Is the underperformance over? The point that I was trying to make is that Q1 is a seasonally weak quarter. It is there for all banks to see, and HDFC Bank is no exception. Added on top of that is the merger impact, because this is the last quarter where you will see that merger impact play out. July 1st onwards, so the July-September quarter, you will probably see the well-adjusted numbers, and 1 year later, things should start looking better. Now, what has happened at HDFC Bank in Q1 of FY25? You saw your advances shrink by about 0.8% quarter on quarter. Deposits are mostly flat. CASA deposits shrank by about 5% quarter on quarter, largely because of the current account deposits having seen a net outflow of about 42,000 crore. All of this said and done, Yes, not such a great set of numbers. Yes, if you look at it from a merger adjusted number point of view, which HDFC Bank has given for this quarter, advances and deposits are okay. I mean, they're not such a great set of numbers, but about 14.9 and 16.5 on the deposit side. So, okay, okay. But my question is, do these merger adjusted numbers show the true picture? Now, the fact is that in February, we had Arvind Kapil hold a press conference. Now, Arvind Kapil, of course, has moved on from HDFC Bank since then. But in February, when he held the press conference, he was talking about the intangible benefits of the merger. Yes, you see an immediate boost on the mortgages as soon as the two entities come together. But the intangible element is the cross-sell, right? So let it be consumer durables, credit cards, wealth advisory, or even on the savings account side, where a large part of the HDFC Limited and HDFC Bank customer base was separate. So you start seeing that merger happening. His point was that this will ensure that the growth pushes up quite a bit. It was already pushing it up in February of 2024. So this June quarter number, we have to assume that this merger adjusted sort of comparison may not be accurate, because the merger adjusted number might actually be way worse if you take out the cross-sell benefits that come into HDFC Bank. So not looking so great. Brokerages are, well, sort of midway there. They're saying, oh, I mean, yes, not such a great set of numbers, but we will probably see some amount of action on the stock. But we are pretty sanguine on the stock. I think it's way worse.
So, Vishy, the question here is that, when the third quarter earnings came in, that's where we saw deep cash in HDFC Bank. After that, we had the earnings for the fourth quarter, which seemed reasonably okay. The question is that all the concerns that came through in the third quarter earnings, were all of those concerns answered in Q4? Do you think that the bank was turning a corner? And based on that, what can we look at now?
Yeah, so the main concern was on margins. Now there again, the bank has guided. It's not that everything is solved yet. They are in the process of solving it. It's been 1 year since they've been solving it. So hopefully in this quarter's commentary, we will see some indication of what exactly happens going ahead. But considering that deposits have not grown at all quarter on quarter, you might not see that impact on the margin side. The other side is with respect to growth. Again, concerns there, not fully addressed. Q4 sort of got washed over because the numbers were so big that people stopped asking about it. But now that question is going to come back to the table again.
You reckon, sorry, can I slip in a question?
Yeah, absolutely.
You reckon that July, August, September could see a materially different quarter, reportage, texture-wise, than what the previous ones have been?
May not be Q2, maybe Q3.
Maybe Q3.
Yeah, because that's when second half of the year typically is a stronger year for all banks. So you may see that additional benefit, plus the merger benefits playing out later in the year. So most likely Q3 is when we will see that benefit.
Hazard a guess as to how the stock could potentially open?
I am not going to get
into
that.
Both of you, actually.
But no, I think safe assumption that one, it could start off lower based on what the brokerage notes have been. The only cushion, unlike the last time's fall, is that there is this technical trigger at the back of the mind of the market that the passive flows might shore it up. So do you want to go naked short on it as strongly as you otherwise might?
Yeah.
Right.
Maybe not.
Well, on a technical basis, to cover that up, there were a significant amount of shorts covered as far as HDFC Bank's concerned when, the MSCI adjustment, updates came through. Also, it went into a new range after a really, really long time.
Yeah.
So the question is, are investors just
go back
ready enough to, potentially go and press the button and sell those shares or no? Well, that's a wait and watch. But yeah, fair enough. So these are some of the factors that we should be keeping an eye on as far as HDFC is concerned. But from there on, we move on and talk about information technology. Neeraj, what are the expectations? I reckon that once again, in this case as well, it's going to be a seasonally weak quarter.
Yeah, but Agam, just before we get to Q1, I just thought the reason why, let's try and see if we can put into context the reason why post June 20, and why that date is important, because Accenture numbers came out then. And post then, there is a bit of a further rally that we've seen there. So I tried to do a bit of a P multiple piece if we were on June 20th today.
Right.
Right?
Yeah.
So the prices of 6 stocks, I've chosen 6, I've not chosen all the 18 or thereabouts, but TCS, Infy, HCL Tech, or the mid-sized ones, Persistent, Coforge, Birlasoft, a product company, non-product company, etc. and stuff like that. And the multiples for some of those had come off to nearly 2-year lows. For Infosys, HCL Tech, 21 times. For a Birlasoft, 22 times. Coforge, which has usually been an expensive stock, 23.9 times. So the multiples came off a little bit. Accenture's commentary, and therefore the question, why the rally in the last 10-15 days, albeit in the last 1 month. So Accenture commentary on outsourcing bookings and Gen AI was constructive. And that led the street to believe, we did a show with Persistent and Sanjay Jalona, who's now on the buy side, and they said Indian IT may not be doing as badly on Gen AI as people might be thinking. So you got to wait and watch. So Accenture's commentary plus those comments meant that, okay, maybe things will not be as bad. Valuations at 2-year lows, and certain analysts are bullish on commentary for the second half of FY25 from IT companies. We may not immediately see it right now, but we may see it. There's a Nomura note on July 1st, rather, which said that the calendar year 25 looks very, very promising as well. So maybe commentary turns in the second half. So that's the bullish argument. What are the bullish assumptions that people are making in this argument? That growth bottom out in FY25 will improve to FY26. Discretionary demand may not see further cuts, even if it doesn't see further upticks. But we are at the bottom when it comes to the bad commentary on discretionary demand. Margins will improve gradually with the large deal ramp up and hiring pick up in the second half. And Indian IT vendors might just announce generative AI deals. If we hear that, I think that will be music to the ears, because Accenture's whole uptick of that 9% post results, Agam, you would know this better, was because of they announcing Gen AI deals of $900 million. Imagine if Indian IT vendors, which have thus far not done that, announce that, it could be a big move.
Right. Neeraj, I'm looking at the way Persistent Systems has moved over the last 7-8 days. It's okay, so from 4,000 to nearly 4,800, that's a 28% up move. It's not every day that we see something like this. Even in a mid-cap IT company, off late, we're not used to something like that, which begs the questions whether or not we can, in fact, and again, I don't want to base the entire mid-cap IT ecosystem just based on what we can, in fact, expect from Persistent Systems. But the question perhaps is that while historically, growth for mid-cap IT companies have always been higher than your large caps. Could there be a relative outperformance even in the mid-cap IT space? I think that's the big question here. That's at least something that the markets are trying to factor in.
Yeah, I mean, can I just ask you a little bit about this Gen AI business? So the criticism that Indian IT companies get is that they're not really doing anything innovative at home. So what's giving this confidence that maybe that there's going to be more deals and deal announcements later in the year?
So as per Sandeep Kalra and Sanjay Jalona, that every time there has been a naysayer argument written around Indian IT and multiple such instances, Y2K, blah, blah, etc., they have shown the nimbleness to be able to do something. Now, whether they are the leaders on this or whether you need human resource to be able to execute Gen AI, because there are few pioneers, but if everybody else wants to use Gen AI in their organizations, who are not tech organizations, they need somebody to do that.
Right.
IT companies could well be that as well. There is a lovely note from Nomura today about how to play AI through Indian IT as well. So there are people already arguing on that side of the argument. So that is one. And just very quickly ending this, whether can mid-cap IT do much better, etc. They are certainly more nimble. They have a lower base of the legacy business. So if the legacy business is not getting eaten down the way it is for some of the others, then that revenue loss might not be as big for mid-sized IT companies and product companies as opposed to large IT outsourcers, HCL Tech, TCS, Wipro. So that's something to watch out for. And very lastly, the issues to monitor. Some spend polarization towards Gen AI deals. Does it reduce the spend on discretionary spending for something that Indian IT do? And whether bookings will be subdued till US elections are over, because some notes suggested this. That until US elections are out of the way, companies or CEOs are saying that we do not want to think of budgets only. So will we see lackluster demand until November?
No, so absolutely. So implications of the US economy on and the impact that can have on the Indian IT sector, as Neeraj has mentioned as well, that a lot will depend on the commentary from the management. Again, seasonally weak quarter because of margins, because we do have some salary hikes come through, but a lot will come through in terms of commentary with respect to what we can expect, what areas are a lot of these companies focusing on, and discretionary spends, and how much of this discretionary spends is in fact going towards AI, Gen AI specifically. So a lot of factors to keep an eye on. But there you have it. That's your view, and those are some of our thoughts on not just Indian IT but HDFC Bank. Well, on that note, we slip into a short break, and on the other side, you're back with me. I take you through all the cues from the futures and options space. Back in just a bit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
The good part of growth assets is that the more you have, the better your choices are, right? So nothing like money in the bank to sleep well at night, whether it's a medical emergency or that cruise you want to take. I think gone are the days where we think about a simple life in, a rural community. People want vibrant post-retirement lives with travel, with socializing with friends. Maybe you eat out a few times less, but should you see the Eiffel Tower while you can? I think you should. Asset allocation will change as you age, but certainly you need growth assets in your portfolio. You have a great year, you withdraw it, you go for a cruise on the Riviera. I mean, that's life, right? Most parents would like to leave something for their children, but I think that should just be a byproduct of what's left after you've done everything that you choose to do.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Welcome back to India Market Open. It's now time to take a look at the futures and options space and the kind of cues they're throwing up for Indian markets at the moment. Well, yesterday was a day of trade where our key indices for the Nifty and the Bank Nifty did advance, but just marginally, but there was an advance. And well, at least they closed at lifetime highs once again. But there hasn't been as much traction when it comes to their respective futures. Open interest change marginally in the green for the Nifty. In the Bank Nifty, it is the same actually. But the positive is that both these indices are holding on to crucial levels, and we saw a little bit of an intraday recovery as well in both these key indices. But how about the options market? How's the Nifty specifically looking like? So we are still working with a 500-point range, which is based on 24,500 on the higher end because of the kind of open interest that we've seen in the respective calls. And of course, 24,000 puts, that's where we've seen a good amount of, distribution around there as well. But that said, it was a good day of trade for a lot of these counters, which in fact saw fresh longs. So you did have an up move and a sharp one for Lupin, Metropolis and Atul, along with Granules. So all of them looking at good longs coming through based on a sharp up move in their underlying as well. And among stocks which saw unwinding, we did have longs unwind for ACC and Ambuja Cement, but HCL Technologies, Hindustan Copper and REC as well, looking at a good amount of long traction coming through. Well, based on that, let's take a look at what ideas do our experts have as far as today's day of trade is concerned. Well, we have Aditya Arora of Analytic Research who's joining us on the show. Aditya, good morning. Thanks for joining in. I believe the first counter on your radar this morning is from the banking space. Can you take us through that one?
Very good morning, Agam. Yes, the first counter is from the banking space. We are seeing good action in banking space since last 1 week. Although the leadership was in hands of HDFC Bank, now that might have shifted to ICICI Bank, which is doing the heavy lifting when HDFC Bank is down. So this one looks bullish. ICICI Bank looks bullish. One can buy 1230 call at 26.90. One can sell 1260 call at 14.05. Maximum loss over here is 8995 and maximum profit 12,005. So it's a bullish strategy. If the stock goes up, one makes money.
The credit spread for ICICI Bank and a bullish strategy. So if the stock does advance, well, you are in the money making a profit here. What's the other one on your radar, Aditya? I believe it's Reliance Industries.
Again, yes, Agam, it's a heavyweight counter, Reliance Industry, from which could lift the Nifty. Both of Nifty, I think, both the heavyweights can lift the indices. So the trend is positive. Global macro news is positive. So I think heavyweights can do a lot of action and they can continue the uptrend. So Reliance is a buy, and over here one can buy 3120 call at 62.75. Can sell 3160 call at 44.70. Maximum profit 15,365. Maximum loss 12,635. So again, a bullish strategy. If the stock advances, one makes money.
And this time, the only difference between this one and the earlier one is that this, of course, is a debit spread. So, well, you're going to see a net debit. But, of course, once again, well, playing on the upside, you're playing for an up move in Reliance Industries. Aditya, on that note, taking a moment, thank you for joining us and, well, taking us through two different option strategies for two different stocks. With that, it's back to you all.
All right, thanks a lot for that, Agam. So that's the F&O trades for the day. Now remember, today is a big day. It's a day for birthdays, and as we remember, the big bull or the biggest bull of India, Rakesh Jhunjhunwala, on his 64th birthday, we spoke to market veteran Ramesh Damani about the vision for India for the next 25 years in his mind, inspired by Rakesh Jhunjhunwala. Listen into what he had to say.
He taught us was that we need to always remain invested, okay? And while the markets are cyclical, they'll go up and down, and there are periods in which you can, buy and sell. But broadly, you want to remain invested in the market. So I think, and not only him, the other greats of the stock market, I've asked them this question in multiple ways. And the ways is, okay, you've been in this market 4 decades. Which is the best decade that you've seen? Was it when liberalization happened? Was it in the tech boom? Or was it now? The answer question. And both of them would answer, or all of them would answer with the same breath, that the next decade is the best. So I've come back with that phrase that, the best time to invest in India was, of course, in 1991, when Manmohan Singh stepped up and gave the famous liberalization budget for the interim government. That changed the trajectory of our country, and now it's absolutely clear as you look back 30 years that that's what the trigger point was. The next best time to invest in India, and I'm sure Rakesh would agree with me on this, is today. Because you can't win this game if you don't play this game. Unless you invest, you're not going to profit from it. So I would suggest what he would say is that be bullish on this country. This country is a unique opportunity to become the third or the second largest economy over the next 20, 30 years. And you need to participate in that economy in full measure. And whether he says it or whether I now repeat him as a parrot, I also tend to believe that. While occasionally we'll move from cash, we'll move from one stock to the other stock, we enduring remain bullish that only good will happen in this country. I think that's the lesson I've learned from him, and that's the lesson I'd like to pass on to the next generation, that you need to remain invested. To win this game, you've got to play this game. You know, if you're going to be scared of volatility, which is the nature of the beast, it will happen every day. I mean, right now the market's going up. On June 4th, it was going down. Volatility is the nature of the beast. So don't be scared of volatility in the market. Be scared of permanent loss of capital. And I think luckily we're on a good wicket that we won the ovarian lottery by being Indians, as Warren Buffett might say. But luckily, I think we're in the right place at the right time. So my advice to everyone is, you know, this is as good time to invest. You know, I've been asked this question so many times at 40,000 the index, 50,000 the index, 60,000 index. Is it too high to invest? Isn't the market gone up too much? If I got a few dollars for that, every time I'd be a billionaire. I would have come up through my limitations, Neeraj. But having said that, you could look at the index at 6 figures and say, oh my God, is it too high now? So, you know, that's a mug's game. I don't want to play that. I want to remain bullish. I want to remain invested. Advice I got from Bhaiya, advice I also believe in.
Advice I got from Bhaiya and advice I also part to others. Our homage to the great Rakesh Jhunjhunwala via the great Ramesh Tamani, 12:30 p.m. today. We title it India's Biggest Bull. So watch out for this. By the way, Samina, it's also the birthday of another big bull in India, Govind Parekh. Not as flamboyant and outgoing as some of the others are, doesn't come on media that often, but a very renowned name in the investing circles, and it's birthday as well. So it's a big day from a market veteran's birthday perspective.
5th July. You want to mark that down, so that's of course all about birthdays. But let's talk about what we are gearing up for this morning. Kush joins in with the technical view in the markets, and Dipin Mehta for a fundamental view. Dipin, how are you feeling feeling about the markets at this stage? We've had a good run. We've done about 12-13% year to date. June was volatile, but we've pulled out pretty much a miracle of sorts. So far as well, we've been gradually going up. When we compare ourselves to the rest of the world, we've performed in line. Not better than most of our counterparts. Do you feel like that much talked about impending correction is going to happen, and whether or not it's going to happen over the next couple of months?
Yeah, good morning, and thank you for having me on your show. I think when a correction will happen is very difficult to say, and actually even more difficult to say is that what is going to be the trigger for the correction, because I thought the general election results were the trigger for a correction, but that didn't materialize. So I don't really know what can be the trigger. And even softer corporate earnings is not impacting the market because of the surge of inflows coming in from retail investors. So we are seeing a huge volume of capital coming into our primary and secondary market, and that's keeping stock prices elevated. Valuations have gone way beyond what their averages should have been. But that's the story in a bull market, that valuations and P multiples can go even higher without much of a rationale. So as I said just now at 80,000 Sensex and 24,000 odd Nifty, I just want to be a bit cautious, and at least I don't want to put fresh money to work at these levels. And wherever the opportunities are, I think just liquidate holdings, get into some sort of a reasonable cash position. And the strategy to sell should be that companies which have disappointed on their earnings or are the first targets to kind of sell off. So we are waiting for this earnings season to begin in true earnest and see where the problem areas are and be underweight or liquidate those holdings and just wait in cash. If a correction happens, well and good. Otherwise, also, I think existing portfolios are doing well. So just ride this bull market.
A follow-up to that, how much cash do you recommend investors to sit on? So if an individual has an average risk profile, how much cash should one be sitting on? Secondly, you said you would look to liquidate positions where there is an earnings disappointment. So it's a fair assumption for me to make that you wouldn't be looking at liquidating ahead of the earnings season?
Yes, the second answer to the second question is yes. Wait for the numbers to come through. if any of our companies we are holding report a disappointing set of numbers, and it is the second or third quarter where they have disappointed, irrespective of the reason we want to liquidate. And as regards the level of cash, I think that's a very individual decision. If you already have fresh cash flows coming in, from your savings, which you have ready to invest, then I think even 4 or 5% cash level at these points of time is fine. But other than that, I think 10, 15%, 20% cash also is perfectly fine. Mind you, this cash will earn some reasonable rate of return. You could look at income funds also, which I'm sure will do very well as interest rates start to decline. So you could have a rally in bonds and debt market securities, which will give, I would say, outsized returns in the income funds as well. So that I think is the strategy that we like to follow at this point of time.
Okay, thanks for that, Dipin, and words of caution always welcome. Interesting though, because it's just become so difficult to call a top in this market currently. And Dipin would, he's candidly said this in the past as well, that he's gone wrong too when this cash call. But it's always good to know that sometimes you got to have caution in your portfolio and balance the risk. It's good to earn better risk-adjusted returns than just absolute high returns. So, Dipan, that advice is very, very welcome. Thank you so much for that. Really appreciate. Kush Bora, to you now. And great calling, Kush, the last 48 hours that we've done this more often. How are you seeing the markets today? You also took some money off the table on the Nifty, on HDFC Bank, etc. Do you reckon some corrective moves today or not really?
Morning, Neeraj. Hello, Deepan. Markets could get into a bit of a consolidation mode, at least, for today. We could see a bit of a negative bias. Now, while I have also been talking about, how this market is, overheated, on the indices, it's not really correcting. And I completely agree with Deepan that, liquidity is the main cause that's driving. So when there's liquidity and sentiment, you don't really fight it. So, keep trailing your stop losses. That's how I would play. Now, as far as Nifty goes, there is a possibility that, we could head towards 24,500, 24,550 thereabouts. But I think just for the day, there could be a consolidation with a mild negative bias. On the closing show yesterday, Neeraj, we spoke about Bank Nifty showing negative divergences. And, I was contemplating, buying a put, maybe I should have. But there's a possibility that, the Bank Nifty might open lower given the business update that HDFC Bank has given. So a little bit of a caution is building on Bank Nifty. Now, IT and banking were the two spaces that were actually driving the market up. Some loss of momentum is seen in IT also, although some of these stocks have done well, but they are close to the resistance mark. Bank Nifty showing signs of topping out. So perhaps the market too could look at a bit of a consolidation. So just a little cautious, but again, cautiously optimistic. That's what I remain. Bank Nifty setting up for a bit of a downside. 50 to 200 is the level that I'm watching for on the downside.
Right.
So, Kush, in light of that, what are your stock recommendations for the morning?
Well, I will continue to remain bullish as far as the stocks go, because you've seen quite a bit of move on a lot of these names. No stopping some of these mid cap spaces. So emphasis seems to be making a comeback. The turnaround, or rather the rebound, is, I would say, for now complete, because 25.25 was a resistance mark. For the last couple of days, we've tested that level, moved higher from there. So from the near-term perspective, 26.50, 27.25 are the levels to watch for. 25.25 will now act as a support, so should be your stop loss. On the realty ancillary space, Kajaria Ceramic, stellar run, no stopping. Momentum indicators also showing further upside. So 15.55, 15.80 are the targets to look at. 14.80 is where I would place my stop loss.
Yesterday, your call was also on KEI Industries. It was a buy today, sell tomorrow. So you recommended that at about 3:15 yesterday. Do you still hold that call this morning?
Samina, absolutely do. In fact, KEI is one of the picks that I would suggest someone have in their portfolio as well, from a medium to a long-term perspective. And time and again, as I've said, I like to trade in stocks in which I can invest and hold. KEI Industries for me falls in that category. So even if there's any kind of dip, it doesn't really disturb my portfolio, and more importantly my mental state. So KEI Industries does remain a buy on my books. The BTST call that I said yesterday. Let's just have a look how it opens up today.
We've been discussing banks, and the leadership in the banking pack as well has come recently from the private sector names. And ICICI Bank probably more than HDFC Bank, but there was some euphoria around HDFC Bank in the last few days. How do you feel about banks now? What do you make of those Q1 updates? Because while HDFC Bank has disappointed, the PSU banks have actually done quite well in terms of Q1 updates.
Yes, I think in the entire industry kind of analysis, I would say that banks are amongst the industry segment where there is reasonableness of valuations. Good quality banks are still trading at around 25 times trailing 12-month P multiple, 2.5 times price to book. And PSU banks are around that, middling around that 1.5 times price to book and 12, 13 times trailing 12 months. So from that point of view, they are not extremely overvalued. It's just that we are seeing that there is a liquidity crunch, which is having a pressure on their net interest margins. And although I think these first quarter numbers in terms of advances and deposit growth are reasonable and more or less in line, the real figure to look out for is the net interest income, which is dependent on the net interest margin. And I suspect that this quarter also there could be a bit of a compression over there, which may lead to pre-provisioning profits being flat to slightly lower. So that perhaps explains also the low valuations for these companies. But look, long-term prospects are good for the banking industry. If you're bullish on India, you can't be bearish on banks. So from that point of view, I'd like to be a bit overweight on the banking stocks. And the real rally in true earnest will start once the interest rates start to come off and liquidity starts to ease, because that would mean an expansion of their margins. And a lot of that will percolate straight to the bottom line. And fortunately, so far, the NPA cycle has not turned negative. So that's very positive from banking point of view.
So Dipin, if I had to ask you to pick 2 or 3 banks that you hold in your portfolio, would look to acquire, which ones would those be?
So again, disclosure, we are being transparent about our portfolio. So we've got, of course, ICICI, HDFC Bank, and then IDFC First Bank, and I would say even IndusInd Bank. But all the banks are pretty much similar. And I thought Federal Bank is very attractively valued, as also as RBL. So I would just add these 2 names also to our existing holdings.
HDFC Bank, after those Q1 updates, you would not be liquidating positions. Is that a fair assumption? You will wait to see what comes out of the earnings?
It's testing our patience.
But you're going to wait. I'm assuming you're saying patience, so you will remain patient.
Yes, because HDFC Bank typically is always a very big holding, and you need to think through it carefully. It's been a great value creator, and it's a multi-bagger stock for us. And to liquidate a position, you need to be a bit careful. So maybe you can give some more latitude to the bank management and wait for maybe 1 more quarter. But I know it's really testing everybody's patience. If you ask me, just the disappointments keep on coming in HDFC Bank. Let's see, how the results come out and what the management has to say.
Okay. Well, it's not just HDFC Bank. There are other banks too. Puneet Johnson with a quick perspective of some of the others that have reported, financials that have reported. Puneet.
Yeah, thanks for that. So, decent set of numbers from most banks that have come. Let's start with Poonawalla FinCorp first. They've reported a 5% growth in their disbursements to come in at roughly 7,400 crores for this particular quarter. The total AUM has now crossed roughly 26,900 crores, which is up 52% from the same time last year. Apart from that, the gross as well as net NPA are much lower than compared for just 1% and 0.5% respectively. And they've said that, they are maintaining a liquidity of about 5,200 odd crores. When you look at the small finance bank, let's start with Ujjivan first. Total deposits are up 22%, while advances have gone up by roughly 19% in this particular quarter. CASA ratio has dipped slightly by a percentage point to come in at 25.6. That's largely what we've seen the trend in most banks moving to fixed deposits as well as higher tenure loans. And we've seen that guidance for Ujjivan specifically has been trimmed from 20 to 25% earlier to 20% now, and we will be seeing these reflecting in the numbers as well. The third one that we're tracking is ESAB Small Finance Bank, a competitor of G1, we've seen gross advances go up 30% in this particular year, coming at roughly 18,000 odd crores. Deposit growth was very strong, coming at 33% in this particular time frame. CASA ratio has improved for ESAB specifically by 500 basis points to come at 23% versus 18% on a quarter-on-quarter basis though. Finally, on RBL Bank, deposits are up 18%, coming at roughly 1 lakh crores. Gross advances have also gone up by around 18% in this particular time frame, and finally we've seen some compression on CASA as well, but it's a little higher than estimated, coming in at 32% versus 35% on a quarter-on-quarter basis. So we'll be looking into if this was gone into the fixed deposit. But overall, these are just a brief picture of the few banks that have reported Q1 earnings, largely decent set of numbers. Back to you.
For ESAB Small Finance Bank as well, there is one wherein the CASA ratio is actually expanded quarter on quarter, so that could be an interesting one, and then other numbers also looked okay. We need to slip into a break though. We'll be back with the pre-open session in moments from now. Stay tuned.
Specific PIN codes are not basically given insurance. Specific occupations are not provided insurance. People who do not have educational qualifications, undergraduate, are not provided insurance. So in short, term insurance is a very elite product for a country like India. Right?
Okay.
If you look at the percentage of people, when you cut down all these cuts, like when you put all these cuts into picture, it will not be even 1% of the population of India.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dream?
Back. You're watching India Market Open, and the stock of the morning is going to be HDFC Bank, not on the buy side, more like on the sell side. Rahul Malani, DVP of Fundamental Research at Sharekhan, BNP Paribas, joins in. Hi Rahul, thanks for joining in. Rahul, this week has largely been about HDFC Bank. The first part of the week, it was excitement because FI holding positions were going to go up. The stock got a bump up. This morning, of course, we're waking up to news that the Q1 update isn't looking very promising. Now, we do understand that seasonally Q1 is a soft quarter, but these numbers seem to be, to us at least, below what the expectation was. Do you agree? Are you disappointed with these updates coming in from HDFC Bank?
So firstly, good morning. So outcome on the advances is the expected lines as deposit growth continues to be weak. Currently, the focus was on deposit mobilization for HDFC Bank as due to elevated credit deposit ratio. But although we need to take into account that quarter one is seasonally a weak quarter in terms of flow perspective when compared to quarter four. So comparing quarter four and quarter one will create some noise, but overall we need to see the deposit flow is always stronger in H2 of the year. So we believe that HDFC will able to recoup and will maintain its into 20% incremental market share in deposit. As far as these numbers are concerned, these numbers are below estimates because we were penciling around 2%, at least 1 to 2% growth. Due to these numbers, there would be certain marginal miss in the net interest income front, while NIMs will remain stable because retail loans have grown by around 1.5% sequentially, and that will offset the increase in cost of funds.
Rahul, if you indicate that you expect the second half to be materially better for HDFC Bank, in that case, if we do see some weakness on the stock between, say, now and the earnings season, would you look to lapping up HDFC Bank? Because brokerages do believe that it's very well priced, and the upshot on HDFC Bank at these levels at least is limited. What is your opinion?
So basically, if you look at the last 1 month, there has been a strong outperformance due to the expectation of the increase in the MSCI weight. So we believe that stock will continue to consolidate on a downward bias from now time to the earnings time. So we believe that the valuations are still reasonable. But if you look at the overall growth scenario on a positive basis, on a optimistic basis also, we believe that over the next 2 years, the growth can be in the range of 14 to 15%. So on that basis, the stock is already fully priced from as of now.
So I'm assuming then you're not going to buy HDFC Bank in the current weakness, even if there is a recovery expected in the second half of the year?
Correct.
Okay. Thank you, Rahul. Good talking to you. Actually, just quickly before I let you go, if not HDFC Bank, is there any of the banking names you're bullish on, the firm is bullish on? I think we've lost Rahul, but HDFC Bank, as expected, has opened with a gap down, 2.5% in pre-open trade, 1690. Is what the stock is trading at. The benchmark as well should see a soft start to today's day of trade, 1690 in HDFC Bank. So whatever it added on back of that FI increase in allocation is given up on HDFC Bank in trade. So it's back below levels of 1700 on the counter. A quick check on Nifty as well in terms of pre-open trade. It is expected to be a slightly lower start, 85 points. That's not too bad if you think about it. 24,200 is what the Nifty trades at. These are levels that we've reverted to from the early part of the week. So whatever came in over the last 2 to 3 days is seeming to have been given up in today's session. But remember, the market breadth and the WIX and the PCR are all indicating to the fact that there could not or shouldn't be too much of a sell-off from these levels. But there will be lots of stocks. The stocks largely will come in from the banking names on back of business updates. Other names such as Solar Industries, Mind the Life space will be moving on back of news flow. Well, Dipin, I want to talk to you about one space that is mind-boggling, and it's the defense pack. And in defense, the current theme is shipbuilders. Do you feel like there's more to go for a Cochin Shipyard, a Mazagon Docks, a Garden Reach? Or do you feel like if you've got to play the space, you're better off buying an HAL, a BDL, or a BEL?
Perspective, I want to avoid all the defense stocks. They are completely on a roll. And if you're an existing investor, it's an easy decision, just remain invested. Price to earnings multiple are just keeping on expanding over here. And no doubt earnings will be pretty decent. There's good visibility also. But we have discounted these positives and profit go far too much into the future. So I would just like to avoid any fresh investment in these companies. Also, I believe there is a passive defense mutual fund scheme which has been launched by Motilal Oswal, and that's garnered, I think, about 9,000 crores or so. So a lot of that money also will start going into these defense stocks, which is also why I think we are seeing this rally over the last 2-3 days or so. So there's just too much of money coming into a very concentrated, in a concentrated manner, in a very, I would say, small sector in terms of free flow. Mind you, a lot of these defense stocks do not have a very high free float. So even marginal buying is having an extended impact on stock prices. Valuations cannot be justified at these levels. So I would like to avoid fresh investment, but existing investors can remain invested.
Okay. Existing investors can remain invested, but fresh investors, be careful is what Dipan is saying. Well, but some of those have had a really miraculous run, especially the shipbuilders, as Samina said. You know, the other pocket which got a bit of a leg up yesterday, Kush, were the pharma names. Lupin was not the only game in town. There was Laurus, there was Zydus Life, Sun Pharma was up 1.5% too. Is there a trade in any of those pharma names?
Most certainly. In fact, Zydus Life Sciences was one stock that we recommended during the close of the trade as well. So continue to remain bullish on that. Just to reiterate yesterday's call, 1170, 1195. Are the targets we're looking at. 1110 as the stop loss. One stock that has also caught our attention is the Glenmark Pharma. We've seen a bit of an up move on this one. Volumes aren't really as high as we would have liked it, but the trend for sure has actually turned for the better. So this too is on our radar. If it does open above 1300, is able to sustain above that, then this gets translated into a trade where you're looking at a 1330 and a 1355 as the target. On the downside, 1275 will act as a support. So a conditional trade here because it's close to that 1300 mark where you often see call option build up. But most certainly on the radar. So in a couple of indicators were throwing up Glenmark as one of the stocks. So Zydus Life Sciences, as I said, already discussed. Glenmark will keep on radar. Opening above 1300 will translate it into a trade.
Okay. After a long time, Dipin, we saw some activity in the restaurant/QSR names. And promptly there was some bit of buying that we saw in Restaurant Brands Asia. Forgotten name, but HDFC Mutual Fund bought 45 lakh shares at 110 odd. I don't know if you track this one individually, but if you do, then that. And if not, then, anything in this QSR space that you like?
See, Neeraj, I think that from a long-term perspective, 3 years, 5 years, 10 years, the QSR companies are poised to do extremely well because of the demographics, because of the kind of runway they have for growth in terms of new restaurant openings. And look, even India's highways are shaping up very well. So that also is an opportunity. Urbanization is picking up also in a very phenomenal manner. So that also benefits these companies. So, there's no denying that these are secular growth stories and they'll be around for several years, if not decades. And from a long-term investor's perspective, it makes sense to have a reasonable investment in these companies. Just like you would be buying FMCG in the 1970s and 80s, you buy these restaurant companies in this particular decade. So I think you should see at least, I would say, above average returns in these companies. But there's no denying that last 2-3 quarters have been very disappointing. They have been hit by very tepid, I would say, flat to negative same store sales, and that's a bit disappointing. And also, I think margins are under pressure because of higher costs. So these could be transient issues, but it's not that the stocks are available at cheap valuations as well. So our opinion is to be neutral weight in these companies. And I thought that companies like Devyani, a company in which we and our clients are invested, is a more aggressive player. And I thought that I think that their track record, their execution strategy is amongst the best. So that's just one stock which comes to mind.
I'm going to just extend Neeraj's question further and ask you, how do you feel about alcohol stocks? It's all about premiumization and taking cue from QSR to alcohol. We've recently also seen the listing of Allied blenders. In this space, is there an opportunity to make money?
Yeah, it is, but at a 15-20% correction. And after tracking alcohol companies for decades, I've come to the conclusion you're best off buying regional players, small Indian companies which are very aggressive in terms of sales, marketing, managing the regulatory environment, getting the right price hikes. And I don't think that likes of United Spirits and United Breweries will generate as much returns as, say, a Radico Khaitan or a Global Spirits or, some of those Tilak Nagar Industries. I think that's where I think the real, I would say, the real game is over there. And those stocks could continue to outperform. But right now, they're a bit expensive. And the performance this quarter also may be slightly tepid. So in a bad quarter, in a market which is correcting, if these stocks are available 15, 20, 25% cheaper, and you'll wonder how they are, but your mid-cap stocks can correct by 25, 30%, even in the bull market. So I would say that's a good entry point when P multiples are around that reasonable 25 times, 30 times or so. Right now, they are significantly higher than that because they are launching new brands. The new brands are extremely successful as well. And look, at the end of the day, Alcobev industry is all about managing the regulatory environment and getting the right price hikes and getting the right distribution in place. And these companies have demonstrated phenomenal execution on that.
Okay, that's on liquor. What else? Today, Mahindra Life, by the way, starting off well at the end of the pre-open session. Must say, it's a very subdued start because the Nifty bank is down 1%. The Nifty itself is down 1/3%. IT is flat too, not quite making up for the disappointments in banking. So that exhaustion at the higher levels is now starting to seep in today. Let's wait and watch. Remember, it's a big day from a global perspective as well to keep in mind because a lot of global data comes out in the US later on in the day. Few stocks which did well yesterday. Couple of them, NBCC had a big rolling move in trade, is up another 0.5%. Inox Wind was up about 12%, up another 2.5% today for that one too. So at least two of them I see which are starting off well yet again. Wonder if KEI, by the way, is also doing that. But Kush Bora, the question that I have is on these two, Inox Wind and NBCC. Big moves on both of those yesterday. Starting off in the green, can they do more?
NBCC, NBCC has more room on the upside. The stocks actually, just given a clear breakout above that, 175, 180 zone. So there could be a move that could extend up until 200. And now you have your stop loss, at 180. So the risk reward ratio after the breakout is also favorable. So this one, could do well. Inox Wind is now actually close to that resistance mark of 165, 164 kind of zone. So I would wait up on creating any fresh long positions. I would actually take this as an opportunity to exit partially, if not fully. So more room on the upside for NBCC. Inox Wind perhaps might, hit that resistance and, spend some time sideways.
Okay, we'll watch out for that. So pre-open rates have settled, Kush Bora. If I had to ask you for your one top recommendation for the morning, which one would that be?
So, Neeraj, if I may give to Deepak Fertilizer is a stock that we. Deepak Fertilizer is a stock that, we've discussed, a couple of days ago. This one does have a tendency to move higher even after, let's say, a gap up. So just keep this on your radar. 795 is also on the cards here. 760, 755 where you place your stop loss. But the call to trade is granules. We were discussing, about some of these names earlier. A solid opening after a solid up move in the last about 8-10 sessions. From here on, I think the stock is poised to hit about 540 kind of mark on the upside, 555 as well. And now you place your stop loss close to 505, 510 kind of zones, 510 more like it. So the risk reward ratio here is very favorable. So granules would be my pick. Deepak Fertilizer, keep on radar. If anyone's got an existing position, continue to trail your stop losses in this one.
Right. Deepak Fertilizer is expected to get a good gap up. Angel One, if you can quickly get that in pre-open trade as well, let's see what it's getting up to. There's been some news flow on the counter, so we will be watching out for this one. They've had strong growth in client acquisition. Macrotech developers as well, they've managed to post a pretty solid sales numbers for the first quarter, but the stock is trading higher, but no runaway rally just yet. Well, we've talked about defense, we've talked about Dipin. You want to quickly come in? We've got a minute to go, but in a minute, do you think cement looks good? And if yes, your top pick there?
No, we are neutral to underweight cement. I think far too much capacity is coming up over here. And recently, I had news report that Ultratech and ACC have reduced their cement prices on account of tepid demand. Of course, seasonal factors are also in play. But looking at the risk return and the valuations, I don't want to get overweight cement at this point of time.
Okay. Well, Dipan, thanks for that quick answer. 40 seconds left for the markets to kickstart trade today. Remember, a start which is going to be a lot more sedate than the ones that we've seen in the last 3 or 4 trading sessions at the very least. Banks leading the way lower, led by HDFC Bank. The question is this the start of that maybe much needed pullback as well? Remains to be seen. But the markets certainly will be a lot more subdued today. The top gainer, as we saw in the pre-open session, doesn't have gains of more than 3.5%. That's the extent. But let's see whether during the course of the day, the defense names, the shipbuilders, some of the pharma names build on some gains or no. But here are the first rates this Friday morning. A lot more subdued than what we've seen otherwise. 1/3% lower for the Nifty. The bank Nifty is leading the charge lower, and IT isn't quite helping shore up the gains. Maybe a little bit, about 0.2%, so maybe not bad. Mid caps and small caps, very quickly, see what they are doing in trade. Mid cap index flattish versus red for the Nifty, small caps in the green. Get the heat map up on the screen. HDFC Bank probably in the lower list somewhere here. Top loser, 2.5%, nearly 3% lower for HDFC Bank. The next worst stock is M&M, about 0.7%. Then a Tata Steel, Adani Enterprises, Coal India, Adani Ports, but still a lot more gainers. So HDFC Bank, the principal culprit, pulling the index lower because of the weight, but a lot of other stocks doing well. Bajaj Auto launching the CNG bike today. Watch out for Bajaj Auto, Cipla, Hindalco, Tata Motors, some bit of IT and some bit of pharma, because I saw Divi's too in the list of the top 10-15 movers in trade. So pharma clearly out there. Cipla is now the top gainer, but before Samina takes over, pharma is clearly out there as amongst the top gainers. Metals a little bit and IT a little bit. That's the long and short of the trade today. I think the standout performer is HDFC Bank. Just pull the intraday before we hand it over to Samina for HDFC Bank. 3.3%, or the stock chart of stock price of HDFC Bank, 1668, Samina. This one has really taken it on the chin this morning.
Yeah, it's lost more than it's gained this week. So all that news flow about being added or seeing an increase in allocation from Aeon FIs, the stock had gained, but what you're seeing this morning is it giving up all those gains. 1668 now, 3.5%. One of the biggest reasons you're seeing the markets and Bank Nifty trade lower. So the markets were looking for an excuse to sell off today. HDFC Bank has given it to them on a platter. A quick check on how the broader markets are doing, the mid cap and the small cap index. We should get a sense of what's happening. There's a little bit of outperformance on the mid cap space. The small cap index, on the other hand, trades the cut of 0.3% high in the small cap. Mid cap index also seeing some buying. So the broader market's doing slightly better than the benchmark in today's trade. A quick check on the big movers in the Nifty 500. Mahindra Life stands out. They've signed a deal for redevelopment of 7 projects, and that is the big boost coming in for Mahindra Life space. The stock trades 4% higher. The talk about Raymond demerger, we will be talking to the management and cutting to that interview very shortly. Markets seem to be pleased. The ratio, I guess, is in favor stockholders. The stock is up 6%. Restaurants brand Asia, we talked about that earlier this morning. HDFC Mutual Fund bought 0.9% stake in restaurant brand Brands Asia, and because of which the stock was higher yesterday, but there is follow-on buying today as well. The counter sees a 4% uptick in trade. Lloyd's Metal have pulled this one up only because it was doing so well yesterday. This morning it trades flat, but they've of course got a QIP in the offing to the tune of 732 crores. Solar Industry was a stock of the week with a 30% up move. The reason the stock was gaining was because of the fact they've gone out and made an acquisition in South Africa. Aircon International is doing well on back of winning the deal or the contract from RVNL from RVNL, on back of which Aircon trades the gain of 4%. Cello World, remember we talked about this QIP yesterday, and actually surprisingly went home with gains despite the QIP coming in on a discount. This morning as well, the follow-on action continues. The stock trades marginally higher. But remember, this week is all about, or will be, the next few days will be about Q1 updates. The banks are rolling them out. You have HDFC Bank that Neeraj talked about. I'll take you to the smaller ones that have reported. ESAF Small Finance, those numbers were good for the first quarter in terms of updates. The stock is up 1.5%. PNB and IDBI also did quite well. Both those counters reporting better than expected numbers for Q1. On back of that update, the stock trades higher. RBL and Ujjivan disappointed. RBL is taking a knockdown 3%. Poonawalla trades high, and Ujjivan also trades with a cut of 2%. So that's really what the market is. It's going to be a quiet Friday with a downward bias. Banks are going to be the weak spot. Tech and pharma may see some buying, but we'll have to wait and see. The good news, though, is the broader markets are still trading in the green, Neeraj.
Yes, indeed. Broader markets are doing okay, but a lot of stocks under pressure, I must say. By the way, Inox Wind is now 162 and Wind Energy is about 3% higher too. So that's the one. Wockhardt is back in the green after correcting from intraday highs yesterday. So that's to be watched out for. And I'm sure Samina might Mahindra Life Spaces, but I just want to mark Mahindra Life Space yet again. I want to mark Cochin Shipyard yet again. I want to mark GRSE yet again. So 4.5% for Mahindra Life, 5% for Cochin, GRSE 1.17, and Mazgon, which hit the 1 lakh crore market cap yesterday. Just trying to see what it is doing today, up the percent. What a move some of these defense names are having, and more importantly, the shipbuilders. I know Dipan's advice is well taken.
And Neeraj, did you see that 5.5% on Rail Vikas Nigam? No apparent reason. Ircon has won an order from RVNL, but it seems like RVNL is also getting excited once again this morning. So anything PSU, I think, continues to be the theme. Dipan, you want to comment on that? PSU stocks, you commented on defense, but extend that conversation even into railway names. I mean, railway stocks have also been seeing some active buying over the last few months now.
That's right, I think, again, the same thing as what I said for defense applies to railway stocks as well, that these are great stocks. If you have an ownership position, remain invested, but I think fresh money to invest doesn't make sense. The risk return doesn't favor you. And if you look at the entire PSU basket, I'd still avoid engineering, railways, PSUs, defense companies. Where the value is in the PSU banks. And I just want to think that LIC also is a very interesting stock. A disclosure we and our clients are invested in it. There, I think there is scope for valuation ratios to get re-rated higher. Performance has been gradually improving. They are focusing on bottom line. And most importantly, they have been able to maintain their market share despite increase in competitive intensity. And look, the stock markets are done exceptionally well. So LIC is the biggest investor in Indian equities, and that's bound to have a very, very positive effect on its enterprise value. I don't think a lot of that has got captured in the stock price. So within the PSU basket, I would rate LIC as our top pick. Again, a disclosure, I repeat again, that's a company in which we and our clients are invested. So our views could be biased.
Well, what else? Clutch of names moving around very quickly before we make you hear some more thoughts from Ramesh Damani, but Mahindra Life 5.2% higher on that deal. Dipan, are you negative real estate, or do you like specific names there? Any thoughts on Mahindra Life 1800 crore order win?
No, I think that Mahindra Life is certainly getting more aggressive under the new management, and rightly so. It's the right time for them to scale up their operations. They have the entire resources of the Mahindra group behind them. They have the brand, they have a track record, and they are sitting on reasonably large sized land bank as well. It's been an underperformer as compared to Godrej Properties, a similar company in a similar situation. But I think they're playing catch up just now. So yes, I think positive on that company. But by and large, I'm neutral. A lot of these real estate companies, again, when you rally double, stock prices double, triple, you want to be a bit cautious. I know it can go up even further. But like the same story over here, making a fresh investment, you better think twice. Existing investors, it's great, you just keep on laughing away all the way to the bank that, whatever investment you made 6 months, 1 year ago has doubled or tripled. So from that point of view, it's an easy decision for someone who's already invested. But from a fresh investment, I would be a bit cautious.
Dipan, I know you're not doing any fresh buyings, but is there anything at all in the market that you like? People are talking about how chemicals might have bottomed out. We did talk to Galaxy Surficants yesterday, and they also indicated that demand is picking up. Countries in Europe and Asia are seeing a little bit of an uptick. Of course, they now have supply concerns to worry about. But do you feel like in the chemical space, there could be an opportunity, selective buying at all? Because I'm assuming there is something you're still picking up in this market.
See, no, I think by and large, chemical stocks disappointed. About a couple of years ago, they were a hot story. China plus one strategy and global size plans, expanding capacity, long-term contracts. Those were all the buzzwords which really drove all these specialty chemical stocks higher. But look, last 4 or 5 quarters have been very disappointing. They have behaved like typical commodity stocks. And I don't want to pay a very high P multiple for a typical commodity stock. So I would like to avoid specialty chemicals. They can do well. They're cyclical businesses. So you will see that they can do extremely well also when the cycle is on the upswing. The base effect also will benefit these specialty companies, so they may report big numbers. But at these valuations, I'm not looking at increasing my exposure. But to answer your question as to where are the opportunities in the market, I think in this earnings season, we are going to focus very, very closely on pharma and IT. And we're going to try and figure out the winners in these two packs, because I'm pretty much convinced that the rest of the year and FY 25, 26 will belong to these two categories. Enough of these industrials and defense and capital goods and commodity stocks and real estate. I think they have taken the market as high as they can, and they've been great wealth creators. But the baton will shift to pharma and IT, to an extent banks in 25, 26. So if you want to be a bit early, that's where I think the real winners will come out for the next 8 to 12 months or so.
Okay. Kush Bora, quick opening thoughts. Actually, Dipan, take a moment to thank you on that note, really, and giving us your time. Really appreciate and look forward to talking to you more often. That's Dipan Mehta with his views. Kush, opening thoughts from you based on how you've looked at the scene thus far. Couple that up, of course, with the view on HDFC Bank and the way it's fallen.
Sure. So, Neeraj, last time around when we spoke about HDFC Bank, I said take money off the table. If it's a trading position, if it's an investment bet, I would still continue, to hold on, perhaps even look for a buying opportunity. Not just yet, because 3 sessions of, downward move. Let the fall settle, and perhaps, then we could consider, a fresh buy into HDFC Bank, even from a near to a medium term perspective. That said, the indices haven't really held on to, or rather they've actually slipped further after opening lower, so not really making a good case for themselves in terms of adding fresh longs. So be a little watchful. One stock that I want to leave you with is Thermax. The stock opened quite well, is holding on to its gains, and is just about crossing that 5400 threshold. So from a positional standpoint, I think a 5550 and a 5700 are on the cards. And as far as the stop loss goes, I think 50 to 50 is where you could place your stop loss. But remember, this is more of a positional bet.
Great. A good call there, Kush, the other day on HDFC Bank. It's yielded dividends for sure. Thanks so much for taking the time out and being with us today. That's the view from Kush Bora. Now, as we slip into the break, let's hear out ace investor Ramesh Tamani talking about the big bull Rakesh Jhunjhunwala's mantra, which is always be bullish on India. The reason we are doing this would have been Rakesh Jhunjhunwala's, or let me say, this is Rakesh Jhunjhunwala's 64th birthday.
We've had time to now reflect on his career, and his brilliant career is, I think his long-term compounding rate, from what I calculated, was in dollar terms above 40%. And we really, pillar Warren Buffett for doing it at 24% long term. So he was heads and shoulders above everybody else in his class. So we'll grant him that. But I think the two things that stand out about Rakesh Bhaiya is the first, that he had this unique belief in India. And I think that shaped a 30-year career that he had in the stock market. That he always had only one mantra: always be bullish on India. Never be not bullish in India. So no matter where the market fell, market went sideways, he always remained consistently bullish. And he was never afraid to express that by backing Indian promoters, backing Indian companies. I think one of the qualities that I have found over the last 30 years, that what makes between an average investor and a great investor is, a great investor is willing to take the risk, is willing to put money on the table. And Rakesh was such a fast study. If he liked a company, in 30 minutes he'd close a deal for 100 crores or 50 crores. He had already studied a lot of business models of business companies. So when a promoter bought it to him, it was not new. And because of now his reputation, they were all very cognizant of what he liked: the return on capital, good corporate governance, free cash flow, those kind of things. But what astonished me always in the 30 years plus that I've known him is that he's always ready to put money on the table. He's never afraid of a loss. And he realized that to make money, you need to spend the money and make it rise. So he was not trying to be cute, not trying to protect himself, not trying to hedge himself away, not trying to get away from his commitment. He always said very correctly that his word was his bond. And the ability to be bullish over a 30-year period in India, and we've been through very tough cycles in the last 30 years. It's not that we didn't go through Kargil or haven't had a gold exported or haven't had, but he always felt that progress it would come incrementally, but it would be in favor. The arc would lean towards progress in India. And he was absolutely right about that. He was absolutely right about putting money on the table and betting on unknown promoters, because some of them have created absolutely extraordinary companies. And if there was, as you say, a bull market foretold, he foretold it. And even in the depths of when he was in the hospital, when we visited him in the last few years of his life, even when he could barely speak to me, he would whisper and tell me, Ramesh, don't be bearish on India. He would always admonish me not to be bearish on India. So extraordinary legacy, and I'm really happy that we're celebrating such a happy occasion of his birthday.
So, there is good debt and bad debt. I think there's debt which helps you create assets, which we would classify as good debt. For example, if you take an education loan for something which is truly a good program, good course, which is going to take you further, I think that's good debt. It'll pay back, it will take some time, but it'll pay you back well. The problem is if you over leverage, if you take too much debt simply because you assume that the future is a replica of the past.
As Vishal just said, there's good sugar, there's bad sugar. Your good sugar is going to be from your fruit sources and stuff like that, right? And of course then there's refined sugar, etc., which comes under your what's been labeled as bad sugar, right? So to come down and get into certain financial terms or bringing it into play, I would say budget for it.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Welcome back. You're watching India Market Open. It's a quiet Friday as expected. No runaway gains on Day Street. HDFC Bank is the spoiler and the markets are looking for their reason to sell off. HDFC Bank has given it on a platter in today's day of trade. But like we said, it's no major sell-off on the street. The broader markets are still doing better than the large cap names. There are still pockets of gains that we are picking up on, some being defensive names, defense names and railway stocks that have it good in trade as we see it. But one sector that's been coming up in spurts, at least in terms of stock performance, has been real estate counters. We've seen some of those weekly, quarterly updates and deal announcements on the real estate pack, and they have kept the sector quite excited. Murtaza Arsiwala, Director of Research at Kotak Institutional Equities, now joins in to help us understand what's happening here. Hi Murtaza, it's Amina joining in. Before I talk about the Q1 updates for the real estate sector, what we did see is that in the second quarter of this financial year, we've seen a significant $2.5 billion of foreign money come into the space. The sector is supported not just by domestic participation, but international players as well. Do you feel like this is largely diversification, or is it a fundamental material improvement that the sector is currently going through?
Morning, Samina. Thank you for having me over. Essentially, the way you want to think of it was, if I were to take a period 3 years prior, the sector was not amongst the favorites. Business performance was not to the tops. And there has been, that under ownership is sort of getting covered up in a sense. Business performance for real estate players has been fantastic. I mean, if you look at DLF, which seems to be flashing on your screen right now, being the largest player, a couple of years ago, you were looking at annual sales of about 2,700 crore. That number has moved 5x today to almost about 15,000 crore. So there's been a meaningful shift in business performance. And what's driving that is a combination. There is the cycle which seems to have turned for the better. Market share gains for the larger players are for real. There have been a lot of shifts even in terms of the regulatory environment, which is sort of favoring the more organized players. And it's a combination of these factors which is driving stock performance, business performance, as well as making good the prior under ownership.
Let's break this down, right? And I'm referring to the Collier's report that came out recently, and they've, of course, broken this down. They've said industrial and warehousing segment has emerged as a front runner in terms of absorption of FI flows into India. What do you think? Commercial, residential, warehousing, where does the bias sit in terms of the recovery that the market, that the sector is charting?
In the listed space, which is where a large part of our interest lies, there is no direct play on warehousing just yet. It's an upcoming and emerging sort of subsegment, given, e-commerce is playing an even more prominent part in our day-to-day lives. So warehousing is definitely an opportunity that we are pretty excited about. Unfortunately, we do not have enough direct plays. In terms of commercial real estate and residential real estate, sure enough, on commercial, you have direct plays in terms of the various REITs. On residential, there is a plethora of stocks out there now, even more getting listed. Both have their own individual dynamics. So where on residential real estate, the broader theme is the cycle recovery as well as market share consolidation, which keeps us excited. Inventory levels per se are at sort of historical lows, roughly about 15 months of sales, which is as good as it gets. As far as commercial real estate goes, you did have a bit of a hit on occupancy levels through the course of the pandemic. What didn't help their cause was the SEZ regulation, which did take a little longer than was initially anticipated and led to increased vacancies in the SEZ areas. Both of these pieces, as far as commercial real estate goes, seem to be solving for themselves. So a lot of IT companies, you hear incremental commentary about them making it more obligatory on the part of the employee to return back to office. That's one part. On the SEZ piece, the government in December sort of did suitably amend the regulations to make good that loss of occupancy in SEZ spaces. And that's beginning to see, the previous quarter when we spoke with companies, they said the government's acted pretty fast post sort of amending the regulations, where approvals have already started coming in for denotifying part of the SEZ areas. The operational benefit of that will likely start coming in the second half of the current fiscal. But I think from here on, as far as commercial real estate goes, things could get only better with occupancies slowly creeping back to pre-pandemic levels. So each of the sub-segments that you pointed out have their own strengths areas. We're generally bullish across the spectrum, each with their own sort of opportunity set.
Murtuza, good morning, Neeraj here. When I read your last note, and maybe it is not your last note, but the last note that I read of yours, you were fairly constructive on some of the northern-based players. I had seen mention of a DLF, mention of a Signature Global, etc. Are you preferring that NCR geography from a real estate play perspective, or was it my imagination?
Well, I don't know which is the last note that you read, but let me give my current thoughts.
Sure, yeah.
I think we're generally constructive on residential real estate. As far as NCR market goes, since it's something that you specifically pick up, yes, we are constructive, DLF and Signature Global. In recent times, which is more, let's say, the last 1 or 2 quarters, there has been an element of concern that residential real estate prices have come up very, very strongly in especially the Gurgaon market. In FY24, residential prices in Gurgaon were up about 27%. And if I were to look at the last 2 or 3 years sort of trend, you could argue that Gurgaon prices have near doubled. The concern that the street is grappling with is, has it been really too much of price appreciation, and could that play spoil sport? Our view, yes, for sure, prices have appreciated very strongly and is an area of concern. But if I look at the underlying business performance as late as the last quarter, DLF was still able to sell out the second phase of Privana with as much as 56 billion of sales. Signature in June was able to sell out from one project that they launched in Sector 71 as much as 27 billion of sales. Now, mind you, it could be a tad more soft in terms of the underlying demand versus what you were seeing in the preceding 6-9 months. Having said that, having sold out a project, Privana per se, it was the second phase launch in a matter of 6 months. So I'd say even if projects are sold in a matter of 6 to 9 months, let aside days or weeks, I'd still say it's a good cycle. And for the leading players, I think they have enough ammunition. DLF, notably, the large land bank that it still has access to continues to hold its dominant space in the market. So that's how it is. There is a near-term concern, but I would look at that, I would be opportunistic about that relative underperformance, if at all.
Murtuza, the other question is, a lot of these real estate players, and again, maybe stick to NCR, maybe go to Bangalore, whatever it is, are offshooting into non-residential. I heard you say that you are more constructive on residential, but for example, let's say in NCR, Anantraj has this whole data center addition to itself. There is Max, which is also having this mix of commercial residential with New York Life partnering them. Embassy has this large piece of maybe not co-working as much, but certainly hospitality, as does Prestige, etc. So while you're constructive on residential per se, are there add-ons coming into any of these which impress you enough? Geography agnostic, of course.
So let me qualify that some of the names that you mentioned, we don't cover them. And so my comments would be more from a sectoral perspective as opposed to company specific. But let's put it this way, when you look at it, the common underlying across the board is land, right? Land is the raw material, whether it's commercial, warehousing, residential. And different companies have had different strategies around how they want to play it. Some players are more comfortable with a pure residential play. Some are pure, if you look at the REITs or if you spoke to the private equity players, they'd say, the residential landscape brings about an element of uncertainty, whereas commercial has this sort of regular stream of annuities, which is of comfort to them. But if I look at a lot of the players who've been around for long, I think they'll like to strike a nice balance. In an interaction that I had with Lodha more recently, now they're largely a pure play residential, but they're building some amount of annuity streams, right? Be it through a warehousing business or even some office space. And the way they think of it is the residential piece could be cyclical in nature. We are in the brighter spot of things right now. But, to counter that cyclicality, some amount of stability and cash flows that annuity brings in is good. And so companies have always had a mix and match approach to it. If you speak to a player like Oberoi Realty, he has a mix of, mostly mixed use developments. If you look at his project in Goregaon, or even the upcoming one in Borivali. And their thought process is the alternate assets. For instance, you put in a residential apartment, but you also put in a retail mall, you also put in some office spaces, put in a hotel out there. It just improves the entire ecosystem of the development. So a lot of players have gone for that mixed-use development for different reasons, be it some amount of stability or continuity of cash flows, be it in terms of developing a larger land bank or an ecosystem. And that's how players have played. And usually you've seen this with more larger players where there are mixed use sort of developments. That's not an option that, standalone developers usually have.
We've seen data that shows that the number of houses registered in Mumbai has gone up significantly, 13% in the month of June. You've talked about the north. What happens to Mumbai-based developers? So do you like a Macrotech? Do you like an Oberoi, Godrej, Suntec Realty? Do they feature on your buy list at the current price?
Tricky one. Prices are constantly sort of beating us in terms of expectations. Stock performance has been extremely strong. But we do like, so while we did spend some time talking about NCR, it's not that we don't like players in Bangalore or Mumbai or the micro markets. I think what I'm talking about, Samina, is the broader trends that seem to be holding. If at all, NCR does make me nervous as much it makes the street in terms of the pace of price increase. Mumbai has been a far more measured market, with price.
Oops, Murtaza, I think we might have lost him, but we'll yes, continue, Murtaza.
So, yeah, I hope I'm audible.
You
now.
are audible.
I'm saying, okay, fantastic. So I said, well, NCR is something that does make us nervous for the price appreciation, but it's not, Mumbai with a more palatable price increase in single digits. It's still a good market, and it's the largest market by far. So we are constructive on players like Lodha or even a Suntec, and for that matter, even Bangalore-based players, be it a Brigade, is something that we've liked over a period of time. Price, business performance, they're constantly sort of beating us on the upside, and there's constant evaluation. But that's an ongoing sort of battle that we face.
Lastly, Murtaza, stock or REITs for retail investors? And if REITs, then which ones are your preferred picks?
I think it's not an either-or question in my view. So someone who wants to take a more modest risk and looking at a yield profile, then it would be REITs. Someone who's chasing a more higher growth in the larger residential opportunity, maybe with a slightly higher risk profile, given the lower predictability of residential real estate, should probably go for stock. So it's really on each individual's sort of risk appetite, horizon, and what they're looking for from that portfolio. Typically, REITs would do a 15-20% total return, which is a combination of the yield and the stock price appreciation. Whereas residential real estate stocks, they would not have the benefit of that yield profile, but capital appreciation because of very, very strong growth numbers. I mean, just look at those numbers. Last 3 or 4 years, 40 to 50% CAGR growth in sales, which is huge. And even for the numbers, I mean, Lodha reported this morning, 20% growth in sales is still a great number coming off a very strong base.
Okay, Murtaza, great having you as always. Thanks for taking the time out, and maybe talk to you post the Q1 numbers are out, just to get a sense of how you feel about them.
Sure. Thanks, Neeraj. Thanks, Amina.
All right, that's the view from Murtaza Arsiwala of Kotak. We need to slip into a break, but as we do that, hit out one more slice of the conversation as we remember Rakesh Jhunjhunwala, or the big bull of D Street, on his 64th birthday. Ramesh Damani spoke about his vision for India in the next 25 years, inspired by Rocky. Listen in.
He taught us was that we need to always remain invested, okay? And while the markets are cyclical, they'll go up and down, and there are periods in which you can, buy and sell. But broadly, you want to remain invested in the market. So I think, and not only him, the other greats of the stock market, I've asked them this question in multiple ways. And the ways is, okay, you've been in this market 4 decades. Which was the best decade that you've seen? Was it when liberalization happened? Was it in the tech boom? Or was it now? The answer question. And both of them would answer, or all of them would answer with the same breath, that the next decade is the best. So I've come back with that phrase that, the best time to invest in India was, of course, in 1991, when Manmohan Singh stepped up and gave the famous liberalization budget for the interim government. That changed the trajectory of our country, and now it's absolutely clear as you look back 30 years that that's what the trigger point was. The next best time to invest in India, and I'm sure Rakesh would agree with me on this, is today. Because you can't win this game if you don't play this game. Unless you invest, you're not going to profit from it. So I would suggest what he would say is that be bullish on this country. This country is a unique opportunity to become the third or the second largest economy over the next 20, 30 years. And you need to participate in that economy in full measure. And whether he says it or whether I now repeat him as a parrot, I also tend to believe that. While occasionally we'll move for cash, we'll move from one stock to the other stock, we enduring remain bullish that only good will happen in this country. I think that's the lesson I've learned from him, and that's the lesson I'd like to pass on to the next generation, that you need to remain invested. To win this game, you've got to play this game. If you're going to be scared of volatility, which is the nature of the beast, it will happen every day. I mean, right now the market's going up. On June 4th, it was going down. Volatility is the nature of the beast. So don't be scared of volatility in the market. Be scared of permanent loss of capital. And I think luckily we're on a good wicket that we won the ovarian lottery by being Indians, as Warren Buffett might say. But luckily, I think we're in the right place at the right time. So my advice to everyone is, this is as good time to invest. I've been asked this question so many times at 40,000 the index, 50,000 the index, 60,000 index. Is it too high to invest? Isn't the market gone up too much? If I got a few dollars for that every time, I'd be a billionaire. I would have come up through my limitations, Neeraj. But having said that, you could look at the index at 6 figures and say, oh my God, is it too high now? So, that's a mug's game. I don't want to play that. I want to remain bullish. I want to remain invested. Advice I got from Bhaiya, advice I also believe in.
Specific PIN codes are not basically given insurance. Specific occupations are not provided insurance. People who do not have educational qualifications undergraduate are not provided insurance. So in short, term insurance is a very
very happy to announce that yesterday the board approved the demerger of the real estate business. I think it is very clear path for the Raymond Group to unlock value for the shareholders. And if you see in that step, when the business matures up to a certain level, then we want to show to the world that it is a pure play, net debt free listed business. As we have demonstrated that we did the lifestyle business last year after the sale of the FMCG and making it a net debt free listed business on a pure play basis, which is getting the book record date is happening on the 11th. So everything is done. Now, as we have scaled up in the real estate business, and this was the philosophy very clearly underlaid that we will have the businesses which will have a standing on its own feet, and then we would do a pure play businesses. And as we delivered 1,600 crore plus revenues in the business, 370 crore EBITDA, and 2,400 crore of bookings. And as we speak today, this company is not just focused only on the Thane development, which is the own land. However, it has gone beyond Thane. And we have signed the four JDAs, which amounts to almost 7,500 crores. So if I look at it as a business, we have got a right mix and not focused only on Thane land. So together, we see a scalable, and any demerger takes anything between 14 to 16 months. So we believe by that time, when the demerger really goes into effect, this company has reached, and today itself, it is one of the top 5 builders in the MMR region. And I think that is an opportune time. Now, the reason why we do and why we believe this demerger would be beneficial for everyone and for the growth of the company is 3 very critical. One, what happens is there are certain pool of capital which could be attracted for a pure play business vis-a-vis if you have a company where you have engineering as an investment and a real estate as a business. So I think that is one very important aspect. And in a real estate business, we need to bring capital at some point of time. Though today, when we have announced, as you see, the 31st March 2024, the company is real estate business itself is sitting more than 600 crore of cash. So every year we have a business plan which throws significant amount of cash, as we believe in 20 to 25% EBITDA margin for the business. So if I look at the total potential as we speak today of this business as it stands over the next 7-8 years is in the range of 32 to 35,000 crores. And we continue to sign JDS. So roughly, as I have mentioned earlier also with you all, that we see in the next 3 to 4 years, this company can hit easily a revenue of 4,000 crores with a 25% EBITDA margin, almost like 1,000 crore. So which is substantially good for itself to can run on its own steam. As far as Raymond is concerned, we are very clear that we want to build businesses out of Raymond Limited and do the right structure, bring the company to the investor community, to the bankers, to everyone when it is right. And I think that is the step which we have followed. Plus, it will have very focused board, professional management team. We are already in place. I think everything will be done in a manner that it is a standalone, net debt-free, pure play listed entity.
Right. Got it. And, Amit, so I want to understand, the business side of things for the real estate business. At present, where are the revenues coming from? Is it the premium luxury segment, or is it the mid segment, or affordable houses? And where will your focus be going forward?
Sure. So look, first of all, let me give you a brief outline that in Thane, we have got 100 acres of land, which currently we are building almost on 40 acres, which translates to a revenue base of 9,000 crores. Now, what we are doing in this, we want to say, our motto is, let's say, build India 1, 2, 3. So what we are thinking is 1 BHK, 2 BHK, 3 BHK. Now, the definition of an affordable home, unfortunately, in Mumbai, everything crosses beyond a certain level of value. So therefore, it does not qualify into an affordable as per the definition given in the country. However, if I look at the kind of product which we are delivering to the market, even our 1 BHK, which starts from a 370 square feet, which sells currently around 80-85 lakhs of rupees, you can get kind of amenities which competing builders are not in a position to provide. And what we are trying to give is not you just an apartment. We are focused on giving you a lifestyle. So we have created sort of a branded products. As we believe Raymond is known for the brand, which you all know for ages. I think what we have been able to do is that we have got 10x, which is exponential living, which is a 1 BHK, 2 BHK. The second product is a 3 and a 4 BHK, which is called Address by GS. And the third big thing is called the Invictus by GS, which is like a 4 and a 5 BHK, which is very large apartments. And so we are catering to all segments. But as we have experienced in our Raymond fabric business, that always the belly of the market is a middle 1 BHK, 2 BHK, 3 BHK. And that is a very big focus. This is at Thane. Now, I told you that we have signed 4 JDAs, which is covering another 2 million square feet, over 7,000 crore of revenue, which is in Sion, Mahim, Bandra, and Bandra East. I think that is also in the middle class, which ranges anything between 35,000-40,000 rupees a square feet, which covers 2 BHK, 3 BHK, and a 4 BHK. And I think that is going to be our focus. So as we speak today, between Thane and the JDAs what we have signed, we are talking about 6 million square feet carpet area under construction as we speak today.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
The good part of growth assets is that the more you have, the better your choices are, right? So nothing like money in the bank to sleep well at night, whether it's a medical emergency or that cruise you want to take. I think gone are the days where we think about a simple life in, a rural community. People want vibrant post-retirement lives with travel, with socializing with friends. Maybe you eat out a few times less, but should you see the Eiffel Tower while you can? I think you should. Asset allocation will change as you age, but certainly you need growth assets in your portfolio. You have a great year, you withdraw it, you go for a cruise on the Riviera. I mean, that's life, right? Most parents would like to leave something for their children, but I think that should just be a byproduct of what's left after you've done everything that you choose to do.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize.
Well, thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. Our guest today has written this very interesting note wherein he's talking about how multiple players in the Indian investing landscape are caught between the rock and a hard place. And these players range from the government to other policymakers to maybe the investors as well. Is Ganeshram Jayaraman himself, who's the MD and head of Avendus Spark Institutional Equities, caught between the rock and a hard place when he's answering large institutions about what to do? Let's ask him. He joins in right now on the show. Ganeshram, always good having you. Thanks for taking the time out. Are you caught between the rock and a hard place, Ganeshram?
Morning, Neeraj. Always good speaking to you. Yeah, so of course we are caught because the challenge with the markets today is, as we had mentioned in the note, there are plenty of conundrums which are there, right? On one hand, the big picture on India is still very good, but the multiples are quite expensive and there can be earnings challenges. And within the portfolio construct, we have been very decisive over the last 3 years, maybe about 3.5 years, pretty much from COVID onwards, that the tilt of the portfolio decisively should be towards cyclicals, towards industrials, real estate, financials, autos, and the domestic cyclicals, manufacturing. They've been the clear decisive tilt, and away from IT, away from consumption, okay, and even consumer financials. That has been a very very clairvoyant call over the last 3-4 years. Should you change that? Is the first question. And that question is coming because we think the policymakers, the government will have questions asked due to the election mandate, and not just election mandate, but even prior to that, you had questions around the nature of consumer recovery. Last 18 months, and including in our assessment based on channel checks, even including the June quarter, it's now 21 months where consumption has been slowing down and the K-shaped recovery has been impacting mass consumption. Now, will the nature of election mandate, will it make the policymakers change their stance? And I'll give you some numbers. Over the last 4 years, government's capital expenditure has tripled on not a low base, it's tripled. Whereas government's subsidies, or you can call all the rural spend, that's actually been flat. Okay, so this has impacted the nature of recovery, and clear. You've seen multi-baggers in defense, railways, even cables, all the industrial stocks which benefited from government capex, but consumer stocks have gone nowhere over the last 3 years. Should you change? Will the government's policymakers change their stance? What will be the second order derived impact of that? Will it lead to inflation? Okay, because we have always seen in India, if there is a government push towards consumption, or trying to get the mass end of the consumer's pyramid there, if you take their income profiles higher, it invariably leads to inflation. Then how will central bank react to that? Okay, so that's why we called this whole note is caught between a rock and a hard place, and that has implications for portfolio managers and fund managers or anyone managing money into the markets. Okay, clearly, because how should the portfolio be constructed with not just next 6 months or 12 months, but over the next 36-month view? What should be the decisive tilt? And it's not as black and white as we would have wanted it to be.
So, Ganesh, what do you think, if indeed, as your note says, that there is a middle path with a bias towards fiscal consolidation, what's the resultant impact from a equity watcher's perspective on portfolio and on multiples?
I think, there's another layer to it, which is private capex cycle. Okay? We think private capex cycle will pick up. It has been a government capex cycle, property capex cycle, but not yet a private capex cycle. We think that will pick up over the next 18 to 24 months. Maybe even in the next 6 to 9 months it can start, but it will start with PSU companies, okay? Be it in refineries or steel. You will see private PSU companies beginning capex. I think it will go into the private sector capex next year, okay? And that will bring supply. So if you look at demand, supply, earnings, valuation, there are 4 drivers for stock prices to do well over the medium term, say maybe 24 to 36 months. Okay. And when you look at it, we think supply will go up. We think demand can remain, especially on the consumption side, we think it can remain sluggish. We think valuations can moderate because let's take an example of, say, paints stocks. Okay. Now, it was a cozy oligopoly club for 10 years or more. Okay. One new entrant was coming with a reasonably large capex. The incumbents' earnings have shown no problem. In fact, over the last 3 years, their earnings have grown 75% cumulatively. But the stocks have gone nowhere because market knows that if you're an oligopoly business characteristic of a sector starts undergoing a change, it can have impact on margins, pricing power, market share, operating leverage. It will come with a lag, but markets don't wait for earnings. In a well-discounted market like India, well-understood economy globally by institutional investors, people will be early, and that's why my fear is that there can be an angle, and add the angle of the election mandate-led, not just mandate, as I said, it was coming, and over the last few quarters, this character of consumption will need some kind of intervention and to kind of channel the flows and the economy in a different direction. What should we do? Should we be too early? Can we be too late? Those are real questions to be had, and implications of all of this on earnings will come maybe not the next 6, maybe not 2 quarters, but thereafter.
Okay, Ganeshanam, so based on your assessment of where within this private sector capex will the first inkling show, because we've seen select industries do this. It's not been uniform, but data centers, new age power, etc. There the capex is happening at the private end too. Within the others, where is it that you believe we hitherto haven't seen meaningful private sector capex, but we are likely to see that? I mean, based on either capacity utilization levels or the industry turning or what have you. Private sector specifically.
Yeah, power, steel, maybe semiconductors.
But that's happening, right, as we speak, any which ways?
Power has not been happening. Steel's not been happening. Last many years, cement has been happening. Semiconductors announcements have come. We think that announcements the rubber has not hit the road yet. A capital goods company has still not seen any order book coming from any of the announced semiconductor projects. So have we all baked it into our, have we built a semiconductor industry-led demand potential for a capital goods company, a transformer or a voltage related management companies? No. Okay, we have not penciled it in as growth opportunities for these companies. So clearly, we it's somewhere baked into the multiples, but not yet into the earnings.
Okay. Fair point. Noted. I saw some stray announcements around power for sure, but yeah, you're right. Some of these things have been baked in as well. So, do you reckon, Ganesham?
Just give you a number.
Yeah, please,
Sorry to
please,
interrupt
please.
you.
No, not at all.
To give you a number, over the next 3 years alone, our assessment is India will do about 10 lakh crores of capex in power alone. This number was nothing, literally nothing, any of the last 10 years, 3-year periods.
Got it. Okay. And just before we take that break, Ganesham, the capex on power, right? Do you reckon that the plans, as we understand from the government documents and the stated intent from many companies as well, is that there is a lot of renewable capacity added up, but at the same time thermal isn't going away, and maybe near term thermal capacities might get added up because we are looking at some serious power deficits in 2024 and maybe in the very near term. So will the capex be led by thermal power capacity addition, or will it largely be led by renewable? I'm just trying to understand for the viewer currently to know which ecosystem will flourish more over the course of the next 24 to 36 months.
All of them, but thermal is always scale.
Okay. Can you explain
thermal
that?
Has much more impact on Indian companies.
Okay.
The supply chain has more Indian suppliers supplying for when it comes to thermal, and it has bigger implications on markets. Renewables have a large imported element.
Okay. So thermal will have, all will do, but thermal will have a larger impact on the Indian ecosystem versus renewables per se. That's the point you are making. Okay. Absolutely. Fair call. And I heard you mention about steel as well. Will the steel capex be dependent grossly on how well China turns up its numbers, or could it happen independent of that?
You look at India's steel prices, they're way above Chinese prices. Okay. So I don't know I think it can be independent because, there is some level of protection which is being given to the Indian steel manufacturers, and their capacity utilizations are quite high. So we will see steel sector capex come almost independent of how it can play out from China. But yeah, we will watch China too, no doubt. But I think the capex decisions can be independent.
Okay. Ganesham, stay on. So much more to talk about. We've spoken about the larger bucket around first piece around being caught in the rock and a hard place. I think we'll talk about the here and now on the other side of the break as well a little bit. Investors in HDFC Bank would be caught between the rock and a hard place. We'll try and talk about that a bit. Try and talk about some other recent developments as well. Stay tuned, viewers. We'll be right back.
Specific PIN codes are not basically given insurance. Specific occupations are not provided insurance. People who do not have educational qualifications undergraduate are not provided insurance. So in short, term insurance is a very elite product for a country like India. Right? Okay. If you look at the percentage of people, when you cut down all these cuts, like when you put all these cuts into picture, it will not be even 1% of the population of India.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
are voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Stock selection isn't an easy task.
And neither is choosing the right moment to sell
Whether it's a doubt about a short-term trade
or a long-term investment,
all you have to do
is ask Profit.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
All right, back with Talking Point right here on NDTV Profit in conversation with Ganesh Ram Jayaraman of Avendus Spark. We shift focus to some recent developments as well, and let's shift focus to the banking space. HDFC Bank reported Q1 numbers and they looked a bit soft from what were expectations were. Harsh in fact joins in to tell us just how soft they were. Harsh, good morning.
Hi, good morning, Neeraj. So absolutely flat in terms of deposit growth. That was the key number, Neeraj, that the street was looking out for. Of course, very high base of Q4 FY24, 7.5% sequential was the growth number at that point, and therefore likely on the higher base, flattish growth, but the street not impressed at all. And I'll come to why that will likely be the key. But before that, on the advances front, either not the best news. Sub 2% in Q4 FY24 sequential, followed by a negative 0.85% kind of number for Q1 FY25. That again does not signal the best kind of growth from a loan book perspective either. So somewhere HDFC Bank seems to be losing market share, especially on the advances side of things, largely because deposit growth isn't catching up. What's the key now? What's the possible three key levers which investors are looking out for? One is your loan to deposit ratio shrinking. It's been flat over the last 2 quarters, and therefore a likely shrink there could change the direction in the way in which investors are thinking. Second is that should have a trickle effect on margins, and therefore any margin improvement, any signs of margin improvement could likely be a positive. And last will be your ROE and ROA ratio scaling back higher and good EPS growth. So those are likely some of the factors which investors will be looking out for.
Thanks for that, Harsh. Ganeshram, I'm not asking for a call on HDFC Bank, but could a performance of one bank be isolated to that one bank? Do you expect banks to come out with a decent quarter, or is it difficult because a lot of hope at the current valuations that we have is also laid out on earnings momentum continuing, whatever the number may be, but the momentum continuing?
So we think credit growth will slow down, okay, for the system and for the large banks. Over the course of this year, we think it can further slow down. In excess of 15-16% credit growth is unlikely to sustain even in the current year. Deposit growth can pick up, especially because the system will now start seeing the accumulated government's cash balances till elections getting now spent out, coming back into the system as deposit growth. that can, so at the margin, deposit growth in the second quarter and thereafter can start picking up. But we are still quite cautious on margins. Even credit costs are unsustainably low currently. It can mean revert. So we think the best of ROA profiles of most banks possibly has been seen, and the valuations are not demanding, which is again another part of the caught between a rock and a hard place, because banks are opposite of what we normally like stocks to be, which is we generally like low-balled earnings and high valuations. That's the construct we like, because we know earnings will catch up. Now we are at opposite. We are actually seeing earnings are high and valuations are attractive. Okay, so that can be a kind of a pull, and you might want to say that, hey, things can get weaker, but it's in the price. Okay, and we may fall into that trap on banks. That can be a live risk, but still we do believe that the earnings picture, growth, margins, credit costs, ROAs and ROEs, the March quarter was possibly the best.
So, Ganeshram, from a pure valuation perspective, just trying to understand, are you a bit circumspect, or do you reckon that valuations themselves might come under question and earnings might make the valuations seem a lot more expensive than what they are right now?
Yeah, for almost every other sector than banks, that is actually the truth. Because when you break up the earnings profile, right, there are maybe 8 drivers. Okay, you can say, will it be market share-led volume growth? Will it be industry growth-led volume growth? Will it be a pricing improvement which can come? Can it be a product mix improvement? Can it be raw material prices further going down? Can it be operating leverage? Can it be financial leverage? Is there anything hidden as some subsidiary loss-making segment which can turn around? When you weigh all of these across our entire coverage of 250, 270 stocks, what we are coming to is almost all other drivers have played out over the last 3 years, except industry-led volume growth. Okay, market share gains, we don't see too much upside. RM prices, basically gross margins or pricing power, consolidation-led benefits played out. Operating leverage largely already in the base. Now industry needs to show volume growth pickup. Can more cars be sold? More houses be built? More capex be done? More two-wheelers get sold? So you need the industry growth dynamics to pick up. For that, you need a very strong macro. And for that, you need strong credit growth. For that, you need the government's capex to be quite high, or government spend to be high. Keeping all the first points I mentioned, I think where there can be some scope for downgrades in earnings, and the valuations don't leave too much room for even a moderate downgrades. Valuations are penciling in almost error-free earnings expectations built in. So that's where confusion is also coming, that there isn't a lot of margin of safety in this market, and there can be need for margin of safety inbuilt into the character of earnings profile. That's why we have kept a portfolio construct which has where quality management we are increasing the proportion of them, and increased proportion of cash in the balance sheet in our construct of our top picks, and also have cyclicals like industrials or autos or property related stocks, some segments of financials as well. We have kept the proportion. So we are trying to keep this barbell approach, keeping this kind of a likely scenario. So we need to prepare for either a kind of a binary outlook actually.
Okay, my final question, and your note speaks about that welfare tilt as well. I'm not calling it welfare, Ganeshram, but if there is a government thrust on rural and agri,
in order to revive it ahead of 3 key state elections or however. What is that resultant impact? Because one is for the macros to do well, but not in our hands. 2 is for a specific set, which is a policy for a particular sector or a theme working from the government, even if the macro by and large is not all right. So if the government gives this thrust on rural and agri spend, can it have the potential to change the lifeline for select pockets within the equity markets?
See, don't just look at it as rural. I think their lines are blurring between urban and rural. Okay, it's no longer as black and white as it was before COVID. So I think we could easily fall into a trap and get because we all thought over the last 4 years you would have thought rural is not done well, but tractor sales were very good. So it has not happened in the past, right? So it's not so straightforward as you might want it to be. But at a broader level, consumer, after searching for answers, we still believe that the household, the mass households, okay, I'm not worried about the top 5 crore households. I think their household balance sheets are in great shape. I'm not too worried about the bottom 10 crore households also, where I think government will always take care, and it's not like consumer companies heavily depend on that segment for growth also. My concern is the middle, okay, the 15 to 20 crore households in between. That segment has not seen incomes more than expenditure, and I see debt has gone up there in that segment, okay, and especially in the last 3 years, unsecured personal loans, credit card outstandings, that segment has seen leverage levels on the rise, and in my view that's going to slow down, and that's why I said credit growth will slow down, and lenders will moderate there. Bank lending to NBFCs are moderating, banks lending to retail is moderating. So this can have an implication on mass consumption in that category. I'm also watching how IT sector or in general the whole GCC IT sector jobs play out, because the trickle effect of IT hiring is very high, especially in urban consumption in India. You know, in Chennai, Bangalore, Hyderabad, Pune, maybe even in NCR to an extent. Not Mumbai, okay? So markets, you can look at Mumbai and have a different answer. But these cities, and maybe even the trickle effect next towns like Coimbatore or Vizag, there is a lot of IT hiring led trickle effect into the economy. For every job in IT, 3-4 jobs get created outside IT. So IT has not been adding jobs. You know, it's six quarters, maybe now 7th quarter or in a row where IT might have shed jobs. So I'm watching that to figure out if what can be the implication of this as well. We also watch for as a crude proxy a BSE 500's employee cost. It is growing at the weakest pace, and if you adjust for some of the pension provisions that state-owned banks made in last year, if you exclude that, because that's not cash in the hands of people, it's actually quite weak. So for us, even though there can be a narrative starting in the markets that government might now want to take a more measured stance, there can be an increased tilt towards consumer benefit. We still think the household balance sheet needs to be, I'm not saying repaired to make it sound too much, but it needs some bit of improvement, okay, before consumption starts picking up. So we still remain wary of mass consumption households, discretionary spend coming from there, especially unlevered consumption.
Points well noted, Ganeshram. Fabulous points. Thanks so much for bringing these to us, and thanks so much for talking to us today. Hopefully we get out of this conundrum of being between a rock and a hard place soon. Either ways, either direction. But thanks for joining in today.
Pleasure's mine, Neeraj.
Right, that's the view from Avendus Park, Ganeshram Jayaraman. On the note that the markets are a bit skittish, we wrap it up on this leg of Talking Point. Thanks so much for tuning in.
So, there is good debt and bad debt. I think there's debt which helps you create assets, which we would classify as good debt. For example, if you take an education loan for something which is truly a good program, good course, which is going to take you further, I think that's good debt. It'll pay back, it will take some time, but it'll pay you back well. The problem is if you over leverage, if you take too much debt simply because you assume that the future is a replica of the past.
As Vishal just said, there's good sugar, there's bad sugar. Your good sugar is going to be from your fruit sources and stuff like that, right? And of course then there's refined sugar, etc., which comes under your what's been labeled as bad sugar, right? So to come down and get into certain financial terms or bring it into play, I would say budget for it.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Markets show initial signs of exhaustion. Nifty trades at 24,200 levels. Meanwhile, Sensex trades below 80,000. Most sectors trade lower, dragged by financials and realty, while pharma emerges as the top gaining sector. And HDFC Bank falls over 4% after the bank reported decline in gross advances and CASA deposits. And the UK Prime Minister Rishi Sunak has conceded defeat in the general election as Keir Starmer's Labour Party crosses majority of 326 mark to form the government.
First, to come back to my grandchildren, as I've often told you, I really enjoy my time with Veer and Arna, and unfortunately he didn't get that much quality time that he would have hoped to and not see his kids grow up. That is also a real privilege in life. I've learned a lot from Rakesh Bhaiya and from a lot of other mentors in the stock market. And one of the things was, of course, backing up the truck and buying it. And while I'm getting incrementally better, have I been able to be a good pupil to his teachings? I probably haven't. I probably have fallen short. He would have been happy, but he wouldn't have been overjoyed because, I've still come from a background where, you're plagued with doubt. Whether this will work or not work, whether there'll be a party or there won't be a party, whether the bull market will sustain or not sustain. But Rakesh never brooked any doubts. He was so clear in his thinking, so clear in his thought. When he put money on the table, he had complete confidence in the promoter, in the company, in the business, Well, I am plagued a little by self-doubt. So while I think if I give myself marks, have I gotten better? Yes. Am I at the level I should be? No.
That was ace investor Ramesh Damani remembering biggest bull Rakesh Jhunjhunwala on his 64th birthday. You can catch all that in a special conversation only on NDTV Profit at 12:30 p.m. today. Hello and welcome. This is Agam Vakil and you're watching the FNO Show, a show in which we take you through all that is happening in the futures and options space in Indian equities. Well, it's been a quiet market. Actually, we're looking at benchmark indices under a tad bit of pressure, perhaps on expected lines because it's been quite a week and the bulls have been in charge for most part of it. It does seem like we're looking at just about a profit taking right now, notwithstanding the kind of pressure that HDFC Bank is in fact weighing down on as far as the Nifty is concerned. Speaking of which, let's start by taking a look at the key contributors as far as the Nifty 50 is concerned. About a 0.25% decline for the Nifty 50, and naturally a bulk of that is on account of HDFC Bank. As you can see on your screen there, a contribution of nearly 140 odd points there on the decline. M&M, ICICI Bank, Titan on the other hand also providing a little bit of weakness as far as the benchmark is concerned. And of course on the upper end we have Reliance Industries, L&T and SBI providing support as far as the key benchmark is concerned. To take a look at the mid cap and the small cap indices, at the moment what we're seeing is a little bit of an outperformance. That's where it continues. And remember that a lot of these budget oriented stocks, if I can in fact say that, is the reason why we have advances for both the mid cap as well as the small cap indices this morning. In fact, you have more advances as compared to declines, about 12 odd advances for 9 odd declines. But even in the broader markets, the defense stocks continue to do well, specifically shipbuilding and navy related stocks. So we have Mazagon Dock building on yesterday's gain. Cochin Shipyard also up as much as 7-8% at the moment. We have something like a Garden Reach shipbuilders as well up as much as 4.5%. Besides that, even in terms of your something like an RVNL, that's up as much as about 4. Okay, so it's up as much as 8% at the moment. So significant gains coming in. I reckon that the railway stocks as well as the defense sector will continue to be in focus in the run-up to the upcoming union budget. But that said, how about the futures and options space? Let's also very quickly take a look at that. At the moment, remember that yesterday was a subdued day of trade where we didn't really see too much change in the futures open interest for the Nifty or the Bank Nifty. Today we are looking at unwinding, a little bit of unwinding. So naturally, and as I was suspecting, some amount of the longs that were built through the course of the week are now being unwound right now at the moment as far as the July futures go. Is that the same for Bank Nifty? Well, let's pull that up. The Bank Nifty should come up for you saying, yes, it is. So we do have a decline of around 1.8% in open interest for the July futures as far as the BNF is concerned. But this index is taking a knock of around 1.1% at the moment. So that's something to keep an eye on. Now, let's move on and talk about the options market. And remember earlier on in the morning we were talking about 24,000 as a little bit of a base, a little bit of a support, and it has strengthened over the last few days, and that continues to have the one with in terms of the puts, the one with the maximum open interest at the moment. On the higher end we do have some amount of distribution around the 24,400, 500 and 600 calls as well. Those are the levels that we are watching out for roughly. It's going to be a 500 odd point range as we move into trade next week for the Nifty as well. But on that note, let's get in our experts for today. Well, we have Akshay P. Bhagwat of GM Financial and Jatin Geria of Sherkhan by PNB Paribas, who's joining us on the show. Good morning to both of you. Thanks for joining in. Akshay, your view on the Nifty, how are you looking at things? Are you expecting consolidation or are you actually expecting a direction?
Good morning, Agam. Yes, it's been a one-way rally for the Nifty, and if you look at the trading pattern in the last 4 days, there are clear signs of exhaustion in the Nifty. But for the day, if you look at the stock-wise components, Reliance has turned out to be a savior for the Nifty. So here it's going to be a choppy session. There is the direction is positive from the broader perspective, but for the short term, you will have to get through the choppiness which Nifty might present. So level-based trading is what I suggest. 24,200 is an important level if you are an intraday trader. Till 24,200 holds, you can expect time and again bounce backs in the Nifty index. On the upside, 22,375 to 22,400 would be the resistance zone. And even from a weekly perspective, I'm expecting Nifty broadly to stay within the range of 24,150 to 24,450. So choppiness ahead. If you want to time buy trades in Nifty because the view still stands positive, wait for slight dips around 24,175, 24,200. Those would be good levels to re-enter on the buy side and trade the range which I mentioned. So positive view, but trade the choppiness, buy the dips is what the recommendation is.
Buy the dips as far as the Nifty is concerned. Jatin, good morning. Is that also your view? Are you expecting a direction in the Nifty in the near term?
Good morning, everybody. So, as far as the Nifty is concerned, what we believe that the Nifty has witnessed around 1,000 point kind of a rally, and on the hourly charts, we can clearly see signs of a sideways consolidation building up. Now, some of the parameters which we look at is that one of the parameters that we look at is the Bollinger Bands. So, the Bollinger Bands have started to contract after an expansion. So, this indicates that we could be in some kind of a consolidation in the near term. The broad range of consolidation is likely to be 24,000 and 24,500 on the upside. So considering that we are expecting some range bound kind of a movement, we are suggesting a short iron fly, that is 24,250 short iron fly. We believe that the calls, the 24,250 call and 24,000 put should be sold. This is for the 11th of July expiry, and the hedges should be bought at 24,000 put and 24,500 calls. So we believe that this strategy is likely to be profitable. We are expecting a range bound movement, and that is why we are suggesting 24,250 short iron fly for the Nifty.
Okay, so an interesting strategy here. Of course, it's not an uncommon one to be deployed, especially when you are in fact expecting consolidation coming through. And as Jatin has put it, he is selling at the money 24,200 calls as well as puts respectively. And as against that, in order to limit your losses, just in case if things do go awry, well, he's also looking to buy those wings. So he's buying the 24,000 put on the lower end and 24,500 call on the higher end, so as to, well, make this strategy a limited loss one. But let's shift focus to the bank then. The bank Nifty, of course, is perhaps moving on the whims and fancies of essentially HDFC Bank. That has been the case over the past few days. Akshay, what's your call on Bank Nifty specifically? What's your call on the Bank Nifty, and how would you trading this one?
See, the broader chart pattern for Bank Nifty is still positive. It is just that HDFC Bank's price move in terms of gap down open is weighing heavily on the Bank Nifty just for day trading. But my sense is that if you look at the price structure, the recent swing low, that's around 52,000, is a very strong support zone, all basis via options where a lot of put writing bets are concentrated. And even on the technical price support, 52,000 is working out as a good support point. So my sense is that Bank Nifty too will be bought on dips. It is just a day trading phase where Bank Nifty is open gap down and we are seeing some selling pressure. I believe private banks should once again come to the rescue, the likes of ICICI Bank, Axis Bank, Kotak Bank, some mid-cap banking, they all will come to the rescue to banking again. So I will be searching for buy opportunities between 52,300, 52,400 basis spot Nifty, spot Bank Nifty. If you get these levels, again, get into the long side on Bank Nifty. A recovery rally which may happen next week should again see Bank Nifty moving for levels of 53,850 to 53,900 basis the weekly for the coming, the next week expiry.
All right, that's the view as far as Bank Nifty is concerned. Can we quickly just pull that, constituents of the Bank Nifty again and take a look at which ones are advancing and which ones are not? So there you have it. HDFC Bank and ICICI Bank essentially are the ones which are actually weighing down on the index. But say for that, you have some amount of support coming in from Axis Bank and SBI along with Kotak Mahindra Bank. But that support's not enough. And that's the reason why we have the Bank Nifty wilting under a tad bit of pressure. Jatin, what's your assessment on the Bank Nifty going forward? How are you playing this one?
See, we believe that the Bank Nifty is a little even on both the sides, meaning that HDFC Bank, one of the heavyweight, is having a negative reaction, and that is why we are seeing some negative price action in the case of Bank Nifty because of its weightage in the bank Nifty, and there are other constituents who are trading with a positive bias. So we believe that this divergence between the key constituents of the bank Nifty is likely to result into a consolidation in the bank Nifty. On the levels front, we believe that on the upside of 53,500, which is the high it touched in the previous trading session, and on the downside, we believe that 52,000 is a crucial support. So we believe that around 1,500 point kind of a range we are expecting in the case of bank Nifty over the next 1 week. So in the case of bank Nifty, we are suggesting a 52,500 short iron fly, and we are buying the hedges of 52,000 put and 53,000 call. The max profit is around 5,700 and the max loss is around 1,700. So a quite profitable risk reward perspective strategy. I think we believe that our outlook for the bank Nifty is range bound, and that is why we are suggesting short iron fly of 52,500 in the case of bank Nifty.
Sorry, Jatin, just want to revisit that. You're saying that the iron fly in which the strikes that you're selling is 52,500. Can you please repeat the wings, the strikes as well?
I'm buying the hedges of 52,000 put and buying the 53,000 call.
All right, so 500 points apart from where you are in fact going ahead and selling that particular strangle and thereby converting this one into also an iron fly as well. So consolidation as far as Jatin is concerned, and in terms of expectations for both the Nifty and the bank Nifty. But let's move on and talk about the stocks which are actually moving in trade today and on the base of changes in open interest. So let's pull that list up and see where there is in fact traction. So Divi's Laboratories up 2%. Looking at longs there, Axis Bank marginally in the green, but there are some longs there as well. HDFC Bank clearly shorts being added there, even as it takes a knock of around a whopping 4%. And of course, you have some weakness in Metropolis and Titan as well. Some shorts being built there as well. What about unwinding? Let's pull that list up as well and see where there is in fact unwinding for Bandhan Bank and ABFRL. And okay, so short covering for something like a Cipla and actually, Piramal Enterprises is marginally, in fact, gone in the red, so it would be long unwinding there as well. But let's shift focus and talk about stocks then. Akshay, stocks on your radar this morning?
Yes, so as I mentioned in the opening remarks, Reliance is the savior for the day on Nifty index. And if you look at the broader chart structure for Reliance, it saw a tremendous up move in the last few trading sessions. It's just that the 3 to 4 trading sessions, prior trading sessions have been consolidative on low volumes. The momentum has regained today, and higher targets is what Reliance is setting up for. So it's a straightforward buy trade in futures. You buy Reliance at current market rate for targets of 3245. Second target would be 3297, and the stop loss on this trade would be 3090. The second trade is from the oil and gas space again, which is ONGC. Here, if you look at the price structure of ONGC, it's staged a breakout of the short-term swing high, which was around 280. This breakout has happened in day trading, and now it is setting up for a major breakout about 290 zone. Looking at the options distribution, OI distribution, and the futures build up, my sense is that the major breakout about 290 is on the way, and you should be seeing targets of 297 to 305 very soon in ONGC. So buy ONGC in futures, keep a stop loss of 270 for the targets mentioned.
All right, there you have it. That's a handful of names from Akshay. Jatin, stocks from your perspective?
Yeah, see, we are also looking for buy opportunities because we are seeing stock-specific action. The index might turn range bound, but there are stock-specific ideas. So we have two recommendations. The first one is Container Corporation. See, Container Corporation on the daily charts has witnessed a sharp decline. The decline has a 5-wave declining structure, and now we are expecting a pullback of that decline. So Container Corporation is a buy at current levels. The stop loss is 1035 and the target would be 1095. Another recommendation that we have is Bharat Forge. See, Bharat Forge has witnessed a sharp decline in the last few trading sessions, and now it has reached a crucial support zone, and we are witnessing signs of trend reversal on the lower time frame, that is the hourly chart. So Bharat Forge becomes a buy. The stop loss will be 1640 and target will be 1725.
All right, so well, two more ideas from Jatin coming through. Well, there you have it. That's what our experts make of these markets. And of course, on that note, going to take a moment to thank them as well, both Akshay and Jatin, for joining us and taking us through their views on these current markets, as well as handing us a handful of ideas, trading ideas that we can work with. Well, on that note, also slipping into a short break, and on the other side, we continue with all the action from the commodity space. Back in just a bit.
Specific PIN codes are not basically given insurance. Specific occupations are not provided insurance. People who do not have educational qualifications undergraduate are not provided insurance. So in short, term insurance is a very elite product for a country like India. Right? Okay. If you look at the percentage of people, when you cut down all these cuts, like when you put all these cuts into picture, it will not be even 1% of the population of India.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target?
Welcome back to the F&O show. We shift focus to the commodity space, and we are now in conversation with Biren Vakil, commodity consultant at Paradigm Commodity Advisors. Biren, good morning. Thank you so much for joining in. I see that the first one on your list today, on your radar, is copper. Can you tell us why and what you are doing with this one?
Copper inventory in South Korea sizably draw down of nearly 8,000 ton. LME inventory also down. So I think there is a moderate run up ahead. So I prefer to go long around 865, 870, stop 860 and upside objective 878, 882.
Okay. So that's as far as copper is concerned, but you are also positive on gold at the moment, Biren?
I'm having better conviction in gold because of this little bit political unrest in Europe, and data flow from China is still dismal. So I'm expecting one more stimulus, as well as yen is traded around 48, year low 161. So I think renewed buying from Asian consumers as a currency hedge may lift gold towards maybe 2380, $2400. In domestic term, I prefer to long 72 72,100. Upside objective on conservative basis is around 72,70.
Yeah, these were the critical pointers made by Biren out there. Of course, from one side, he's talking about the potential volatility in the European economy, and on the other side, he's also mentioning the fact that there has been increased demand as far from China and Asian quarters. But Biren, what about crude at the moment? How are you looking at trade here? Expecting consolidation, or do you think there could be a direction here?
On NYMEX basis, 87, 88 seems to be acting as a wall of worry kind of resistance. But once market pass through, clear this hurdle, we may see around 90, 91. Physical market is tight because forward curve is inverted. So I avoid to short this market. But on any dips towards 67, 68, 66, I would prefer to go long with a protective put option and upside objective 7200 around. This is positional time frame, means 1 to 2 week.
Well, besides crude, Biren, are there any other commodities that you are keeping an eye on besides the one that we've already discussed right now?
Zinc is still my preferred bet because here is also market is inverted. Forward zinc is traded in discount. It does indicate tightness. So still I am seeing fairly upside, maybe up to 280, 282. So current setup 271, 272 around. I prefer to go long in zinc or maybe add more positions.
Okay, there you have it. Well, a handful of commodities that are on the radar of Biren Vakil. Biren, on that note, taking a moment, thank you for joining us and taking us through your views on several commodities discussed here. With that, it's also a wrap on this edition of the FNO show. But lost my lineup on the other side. Keep watching NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
The good part of growth assets is that the more you have, the better your choices are, right? So nothing like money in the bank to sleep well at night, whether it's a medical emergency or that cruise you want to take. I think gone are the days where we think about a simple life in, a rural community. People want vibrant post-retirement lives with travel, with socializing with friends. Maybe you eat out a few times less, but should you see the Eiffel Tower while you can? I think you should. Asset allocation will change as you age, but certainly you need growth assets in your portfolio. You have a great year, you withdraw it, you go for a cruise on the Riviera. I mean, that's life, right? Most parents would like to leave something for their children, but I think that should just be a byproduct of what's left after you've done everything that you choose to do.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to
welcome. You're watching the Small and Mid Cap Show. I am Mahima Vachrajani. Well, today on the show we have a cement and infra analyst that we're going to speak to, and we're also going to speak to the FADA president on June auto sales. But before that, let's take a quick check on how the markets are doing. Well, in terms of the benchmark indices, the Nifty 50 is trading within a range of roughly 90 points. Currently 20 odd points away from its day's highs, but we're seeing a downfall in Nifty today, down around 0.3%. So we're seeing some kind of consolidation in the Nifty 50. In terms of Sensex, the Sensex has a wider range today of roughly 400 points. Sensex is also down around 0.3%, but currently 100 points away from its day's high. Now, in terms of the broader markets, if we can pull up mid-cap 150, well, in terms of the broader markets, we are seeing that they're doing a bit better than the benchmark indices. The mid-cap 150 is up around 0.3%. In terms of the small-cap 250 also, the small-cap 250 is up around 0.9%. So small cap 250 is outperforming all the indices today. In terms of the contributors on the Nifty, something that's positively contributing to the Nifty, we have likes of RIL, L&T, ONGC, SBI, and something that's weighing down the Nifty are the banks today. HDFC Bank, weighing down the Nifty by roughly 127 points. There's M&M, there's Titan, there's TCS. That's weighing down the Nifty overall. In terms of the sectors, let's pull up what the sectors are doing. Nifty Oil and Gas is doing pretty well in trade today. Nifty Pharma is also doing very well. There's Nifty PSU Bank that is doing decently fair, but there's Nifty Finance, that is the FinServ, the Nifty Bank, which is under pressure post the HDFC update. In terms of the HDFC Bank update, let's pull up what HDFC is doing at present. The gross advances are down around 0.8% QOQ, the deposits are flat QOQ, and the CASA deposits are down around 5%. So not a very good update for HDFC Bank, which is why the stock is under pressure. It's down around 4%. Let's take a quick look at the Nifty Energy. What's aiding the gain on the Nifty Energy today? If we can pull up the stocks quickly, well, there you go. The entire index is up around 0.8%, and it did almost touch an intraday high of around 1%. And something that's contributing positively to the Nifty Energy is ONGC, RIL, BPCL, and so on. Let's take a quick look at what Ramco is doing. Well, Antique has downgraded Ramco Cements to hold and have revised their target price to 840. The stock is a bit under pressure. It's down around 1%. Let's quickly also pull up Kalyan Jewellers. It did come out with its business update, consolidated revenue growth of 27%. Same store sales growth has improved by 12%. However, the stock is under pressure, down around 0.15%. But let's shift focus to the cement and the infra space. We are joined by today Mr. Ronald Sioni, who is the research analyst of infra and cement at Sharekhan. Welcome to the show, Ronald. My first question to you is that in your note you've mentioned that the industry has sustained the demand for cement in the past 15 years, and the government has allocated around 111 lakh crore infra investment from FY20 to FY25, which will boost the demand. But for FY25, what is the kind of demand trends that you're observing for cements?
Yeah, hi, good morning, and thank you for having me on the show. So cement demand for FY25 is expected to be in the higher single digits, about 7 to 9% YOY, while cement players are expected to outperform this industry growth rate. Most of the major players in the cement space are eyeing a double-digit kind of volume growth for FY25, which would be aided by both ongoing expansions which are happening, and apart from that, the demand industry demand growth which is expected in high single digits.
Thank you, Ronald. This is Nika this side. I track the cement space closely at NDTV Profit. You spoke about, good demand for FY25, but when you talk about what would drive the demand, what are the kind of factors that would drive demand going forward in the next 2 to 3 years, let's say?
The key driver would be the infrastructure sector, as we see, the incumbent government having the mandate for the next 5 years. So there is a continuity of policy, and the thrust on infrastructure is not going to be lowered, and hence we are expecting government-led infrastructure investments, especially in sectors like roads, metros, railways, ports, airports. So this kind of infrastructure investments are expected to continue over the next 4 to 5 years. Apart from this, we are also seeing, a strong pre-sales numbers from real estate companies as well, which are listed. Today only Macrotech came out with pre-sales number with 20% YOY growth. So over the last 1 to 2 odd years, there has been continued momentum in terms of pre-sales, which has been happening in the real estate space, and which is across pan-India level. So this projects when comes into execution, so over the next 4 to 5 years there would be a demand from these projects as well. So both infrastructure-led government spending and housing sector, both should contribute to the demand momentum for the next 4 to 5 years for the cement space.
Got it. Ronald, in terms of prices, pan-India, the average traded prices have remained flat around rupees 345 per bag, that is month-on-month for July. But overall, what are the kinds of trends that you're observing in cement prices?
So April month had been weak in terms of demand due to election code of conduct, and hence we had seen April prices were much lower to exit prices of March. But post that, there has been efforts during June of improvement in prices, but which has not fairly gone through. Overall, for quarter one of FY25, still the prices are down by about 3 to 4%, but it is also owing to weak demand. If we see May and June, both the months have seen improvement in demand compared to April, so there is revival there. So for the sector as a whole, H2 FY25 would be a key period where one should expect cement prices to improve, where also the demand is expected to improve. So post the monsoon season, this would be the two key monitorables which would be weigh on the earnings for FY25 for the cement space as a whole. But yes, cement prices remained weak during April, so that has impacted overall Q1 numbers.
Yes.
Another factor is also the benefit from power and fuel. We have seen petcoke prices, both imported and domestic, have softened a little bit, 3 to 5% sequentially during quarter one of FY25. For July month, domestic petcoke are flat, while US petcoke, is a little bit down 2 to 3%. So there is some headroom in terms of power and fuel cost during H1 FY25, but that may not cover up the entire weak realization during the period.
Yes, got it, Ronald. I know you said post monsoons we could expect an uptick in prices. So are you indicating that there would be price hikes to the second half of FY25?
It is a possibility, but we need to see whether cement players eye for a higher capacity share. As inorganic expansions have taken a front seat, and many larger players are eyeing mid-size acquisitions also. So much would depend on what kind of strategies they use. Whether they would go for a higher capacity market share, or whether they would show some pricing discipline once these acquisitions have gone through.
Yes, and Ronald, I know that volume uptick is expected, but however prices have remained flat. So in terms of EBITDA per ton, I know there's some support from the lower input costs and all the cost efficiency efforts by the companies. But in terms of Q1, could we see an EBITDA per ton decline, and if for which counters would be impacted the most?
Actually, we are yet to come out on preview numbers for the cement space. hence you would have to wait for that. But it looks like there would be a sequential pressure on operational profitability, but the investors may not look at this near term pain. They would take this as a buying opportunity if there are weak results during H1 FY25, because post that there is a good positive outlook for the space. So this could provide a buying opportunity if they underperform the market expectations. But we are still to come out with the preview numbers.
Got it. Ronald, now, in terms of cement companies in the southern region, they were quite fragmented, but the last 5 deals that have taken place have, kind of consolidated the overall cement space. So, considering this, what kind of pricing strategy are you seeing? Do you think that, the prices will go up, or do you think the prices will come down, considering, this could lead to a cartel?
Southern space, if we speak about, then there is a great volatility. Suddenly there is a sharp fall in the prices, and suddenly there is a spike in the cement prices. But yes, last acquisitions, by Ambuja Cement through Penna and Ultratech making a strategic investment in India Cement, is putting a pressure on southern players like Ramco Cements, which has been under pressure recently. But on the demand front, the southern region is also expected to see a very strong demand. And we should not forget that southern region has also given a strong double-digit volume growth for over the last trailing 2 to 3 quarters. Hence, if the demand momentum continues, that there should not be any problem in terms of cement prices. They might remain stable to they might also improve a little bit. But it all depends on the continuity of demand, which as of now looks very strong in the southern region.
Thank you.
Especially with government continuing in Telangana.
Yes, and Ronald, in terms of the cement space, what would you say are your top picks, from investor point of view at current valuations?
So we have seen, Ultratech, getting a good head start in terms of valuation. It's almost trading at 18 to 19 times EV to EBITDA on FY26. Earning size players like Sri Cement, Dalmia Bharat, Ramco, JK Lakshmi Cement, they are yet to catch up on the valuation front, and hence we see the opportunities there. In terms of Sri Cement, Dalmia Bharat, Ramco Cement, and JK Lakshmi Cement, to catch up on valuation and good picks to buy.
Ronald, now, I'll try to shift focus on the infra space. The government's continuous push to boost the infra space overall has, remained the goal for the past 10 years. And now that we have government continuity and policy continuity, what kind of changes are you expecting this budget for the infra space? And what kind of policies do you think will the government come up with to boost these infra companies?
So I think there would be a continuity, and despite lower number of seats for the majority party, still they would like to show that the focus on infrastructure would continue to be there, despite some kind of populist measures. But road sector would continue to be the front. Road and railways would continue to be the key sectors in which infra investments would be targeted, and they may provide a roadmap not only for FY25 but over the next 3 to 4 years. What kind of investments and where they are looking to increase the capacity in terms of roads, railways, ports, airports. So more or less, you should see continuity. And once, as this election code of conduct gets over, we are already seeing, uptick in road tendering activities. So this has really started. And big ticket size, larger projects may get, announced. That would also provide, a respite in terms of continuity in demand and government's focus on infrastructure investments.
Got it. And Ronald, for railway stocks to be specific, they've run up quite a bit since the past 1.5 years now, and their valuations have also been quite heavy. So where do you see, what are the pockets where you see value at present when it comes to railway stocks?
Actually, I do not have covered railway stocks, but in infra, I look after KNR and PNC Infratech. So these are the two preferred picks in the infrastructure sector.
Okay, and in terms of valuation, where do you see the value right now, whether it's the large cap, small cap or mid cap for the infra space?
The value would lie, of course, on the large cap because players like L&T, larger players, are much more in a comfortable position to eye or to bag a large ticket size project because the project sizes has increased and so has the technical capabilities which the players should have to execute this project. So yes, larger and mid size players should benefit in terms of bagging the projects.
Okay, Ronald, well, point taken. Thank you so much for sharing us those insights on the cement and the infra space overall and taking our time and speaking with us at NDTV Profit. But with that, it's time to slip into a short break. Up next, we're joined by Manish Raj Singhania of FADA. Joins us later on the show, post the break, to talk about the auto sales numbers on auto sales number of June on the other side.
Specific PIN codes are not basically given insurance. Specific occupations are not provided insurance. People who do not have educational qualifications undergraduate are not provided insurance. So in short, term insurance is a very elite product for a country like India. Right?
Okay.
If you look at the percentage of people, when you cut down all these cuts, like when you put all these cuts into picture, it will not be even 1% of the population of India.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Stock selection isn't an easy task.
And neither is choosing the right moment to sell.
Whether it's a doubt about a short-term trade
Or a long-term investment.
All you have to do
is ask Profit.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple.
If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
Welcome back. You're watching the Small and Mid Cap Show. Well, now we're joined by Mr. Manish Raj Singhania, the president at FADA, to talk to us about the June auto sales data. And we also have today on the show Puneet, who tracks the auto space at NDTV Profit. Manish, my first question to you is that, the extreme heat and delayed monsoons have overall affected the rural sales overall. What are your views on that, and going forward, what are you expecting?
So the month of June saw on a YOY basis on two-wheeler segment a growth of 4.66%, but passenger vehicles were definitely hit, and there was a drop of retails by 6.77% in PV segment. The main reasons we could attribute was the delayed monsoon. Like monsoon kind of after Maharashtra, it kind of stalled, and for the month of June there was overall 11% drop. And during a member survey, we could understand the walk-in inquiries in two-wheeler dealership due to heat wave. There was a drop of 13%, and in passenger vehicles, there was a drop of 15%. The maximum conversion that a dealership gets is from walk-in inquiries. So all these drops definitely led to lower customer inquiries and hence lower retails. The kind of customers also postponed retails during these times, and plus the engagement of many customers during the election time, their involvement in election duties and whatever, that has also resulted, taken a toll on overall retails for the month of June.
Mr. Singhania, thanks so much for joining us today. I just wanted to get into a bit more detail of what you just spoke. Especially for the rural sales, because in this month we have seen generally June being a very slow month for the auto sector because of sometimes delayed monsoon as well as other factors. But what's interesting in this particular month was that sales for someone like Maruti Suzuki as well as Hero MotoCorp were quite high, and even in the monthly data that they have reported, it seems like they are building up inventory further as well, because we've seen the highest growth in terms of them. What are you seeing on the ground with specific to these two companies, and not just these two, just the sector of the rural space? How are you seeing, you mentioned about the walk-ins part, but we've seen this particular trend. Is there something that you can see on the ground as well for the same?
So, see, Maruti has continued to maintain market share. I won't say there's a number growth. They are averaging around between 40 to 41% market share. And Hero Asset, they have lost market share. Primarily, Honda, when we transited to OBD2, Honda motorcycles were not able to ramp up their production for OBD2 compliant vehicles. Now, last 2-3 months, we are seeing their numbers are being pushed, and they had lost market share because of non-availability of vehicle. Their normal market share used to hover around 25%. Now, for the last 2 months, we are seeing that they are regaining that their market share. So the advantage that the Hero had with the absence of Honda products in the market, that Hero is losing kind of right now. But yes, definitely, as you know, Maruti and Hero both would be very critical for the, if the rural market revives, these two companies would be the most benefited. Why we also say that we are cautiously optimistic, and we are kind of seeing a rural revival happening. Since last festivals, we have seen a steady growth in rural market, and rural has been pumping up numbers steadily month over month. Plus, government has additionally for the Kharif crops, they have given an additional increased MSP of almost 35,000 crore that would be plowed back in the market. Plus, in the month of July, now we have kind of, the entire country is covered with monsoon, which is now ahead of schedule. So all this would be very critical in getting the right quantity and quality of Kharif crops across India. What is very important is the IMD also projected above average monsoon of 106%. As we know, all this can lead to flooding in some states. That can really dampen the spirit of rural market. Otherwise, if all things are placed And with the right kind of schemes and new model launches coming up and the proper monsoon evenly spread and with the increased MSP, we do see a good revival or good advantage of rural market in coming festive season.
Understood, sir. Now, just to briefly just talk about and finish the discussion on the passenger vehicle space, we have seen certain inventory build up as well, and in the release that you had also mentioned, it has increased ranging between the 62 to 67 day mark. Currently, how are you seeing this going forward as well? Do you see that from July onwards, generally the trend has been that inventory is built up around the April to May, but this year it has continued. And specifically also on the compact SUV space, how are you seeing this particular space within the passenger vehicle? We've seen a lot of interest as well. So how do you see, just to finish the argument of passenger vehicle, and I had another question on the tractor as well as the commercial vehicle space.
So see, actually overall, if you look at it for the auto retail industry,
seems to have lost him.
Yeah, seem to have lost him. I think let's take a quick look at how the auto sales have been, Puneet. The two-wheeler category has seen positive YOY growth of around 4.6%. Three-wheelers were increased by around 5%. Passenger vehicles declined by around 6.7%. Tractors have seen a significant decline of around 28%. But, when we were speaking before the show, you said that we are kind of expecting some kind of recovery in H2 of FY25, basis the monsoon that IMD has predicted and, so on. And commercial vehicles have seen a significant decrease of 4.7%. But I'm sure you have the company-wise data as well, just if you can throw some light on that.
Yeah, definitely. And what's interesting is the segmental data as we spoke about, within segments, we've seen the commercial vehicle space coming back, but on a slower edge. But the passenger vehicle space is where we've seen a lot of action. Mahindra and Mahindra are definitely a key winner here in this particular space. And even the July numbers that have come out on the 1st of July, which is the wholesale data, we have seen Mahindra and Mahindra grow very strongly, upwards of 20%, while someone like a Maruti as well as Tata Motors have lagged that growth on a slower basis, growing just, the low single digits of 2 to 3%. And going forward as well, within the two-wheeler space as well, we think that, TVS, Bajaj, both are trying to get back. But as Mr. Singhania was also pointing out that Honda has solved most of its supply chain issues, which affected sales last year. And that's why we've seen upwards of 50% jump in sales, and specifically the two segments of 125cc as well as the premium motorcycle space. And definitely, just to end the two-wheeler argument, where Royal Enfield is not performing as per expectations, and we are seeing those highlighted in the number as well. In the premium space, of course, is going to be one of the key spaces to watch out for. But definitely just these two segments which we were talking about with Mr. Singhania as well, very much in action.
Sure. So I think the two-wheeler space is something that we'll be definitely watching out basis the monsoon prediction also the IMD has made. But with that, we're completely out of time on this edition of the Small and Mid Cap Show. It's all that we have on the show for now. Stay tuned for more news and updates on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the portfolio manager.
Stock selection isn't an easy task.
And neither is choosing the right moment to sell. Hello and welcome. You're watching Ask Profit on NDTV Profit. I'm Smriti Chaudhary, and this show is geared about your stock-related questions. Write to us on any of our social media channels or on the WhatsApp number that's flashing on your screen. Now, needless to say, it can be a long-term investment query or even a short-term strategy that you're looking for on a particular counter, and we'll take those questions to our guests. But before that, let's take a quick check of the markets. You have the Nifty 50 losing some ground, down about 0.2%. Let's pull up the contributors. It's been single-handedly down because of HDFC Bank, which is also the focus for today, and we'll discuss why that is. It came out with its first quarter numbers, and we'll talk about why such a reaction in HDFC Bank. On the other hand, you have Reliance, L&T, SBI, kind of in the green, contributing a little bit to the index. On the broader end of the spectrum, you have the mid-cap index doing much better than the benchmark, up about 0.3%. On the other hand, small-cap index up about 0.7%. Let's also pull up the advance decline ratio, firmly in the favor of the advances right now. Yes, started off strong, switched a little bit in the middle in the morning trade, but now again firmly in the green. Let's also look at the sectors as well and see what's doing well and what's not. You have the pharma index up about over 1%. You have PSC also up 1% in trade, followed by energy and PSU banks. Pharma doing very well for the second day in a row. On the other hand, finance and bank as expected. There's services, realty, media and auto also in the red. Let's also talk about some of the specific counters that are moving. Let's pull up Raymond. Now, it announced a demerger of its realty business and it has a swap ratio of 1:1. So if you're holding a share of Raymond, you're going to get one more share of the realty, and it's up 17%. Now, while this was on the cards, it was quite expected, but still the stock doing fairly well in trade today. Let's come back to HDFC Bank, which is the focus for today, and as I mentioned, single-handedly bringing the index down. Now, it came out with its first quarter numbers, not a good set of numbers for sure. I'm joined by my colleague Harsh to break down those numbers. Harsh, tell us okay, we saw the numbers, not a good set of numbers, stock being punished in the market, but what are you understanding from this set of numbers, and what are we set to see beyond the first quarter numbers as well?
Well, yeah, absolutely. So to kind of contextualize this first off, absolutely flat from a deposit growth perspective, 0% growth. But you saw Q4 FY24 at 7.5% sequential growth, which was extremely strong. So it was a higher base, of course. They've been able to maintain that at 0% now, so not really growing at all in Q1 FY25. And the real concern is with regard to loans though. So you're looking at loan growth which is minus 0.8% on a sequential basis. And in Q4 FY24 as well, it was just about 1.6%. So essentially, the growth over 2 quarters is less than 1%, which is abysmally low. Of course, reasons for that, management commentary awaited, which will likely come out post the results on the 20th of July. So that will be awaited and keenly awaited. But just in terms of what's not doing well, wholesale is not doing well, and retail, they are ceding market share as well. Retail loan growth not really picking up in the way it ought to for HDFC Bank. It's also a bit of a conscious calibration with regard to bringing down that loan to deposit ratio. in likely to try and focus in on margins as well as profitability. And that will be the key pieces which will turn things around. One is your loan to deposit ratio needs to come below the 100% mark, which is currently at 105. Margins need to go up from the 3.5% all the way to 4%. And you need to start seeing EPS growth. So likely the street not anticipating too much of that in this quarter at least.
All right. Thank you so much, Harsh, for those details. Now, let me introduce you to the guests. We are joined by Rajat Bose, and we'll shortly be joined by Vineet Bulinchkar as well of Ventura Securities. Rajat, I'm going to come to you on HDFC. While, of course, there's a fundamental trigger on the counter, but only a couple of days ago, we were talking about HDFC for a completely different reason, right? And today, the stock is being punished. However, there is obviously...
I have put my other network, this thing is...
There is obviously a reason there's obviously this thing in the back of mind of investors about the MSCI, these passive flow that might come in on HDFC Bank. How are you viewing this? And talk about the Nifty Bank Index as well, because HDFC Bank is pulling that down as well. Right. All right. Seems like there is an issue with Rajat. All right, we have Vineet on the line though. Vineet, thanks for joining in. Welcome on Ask Profit once again. We were talking about HDFC Bank. I don't know if you had a chance to listen to what Harsh was talking about. He broke down those numbers for us and talked about not a great performance. And I was telling Rajat as well that second time we're talking about HDFC Bank in just a week for a completely different reason. But Vineet, this is obviously a seasonally weak quarter as well. There's an effect of merger as well that's on the numbers. How do you see this kind of playing out from a longer term perspective? Obviously management commentary is key and we're going to listen to that, but how are you seeing somebody who's holding an HDFC Bank, we saw a run up in the counter and now down about over 4% in trade today?
So, there are a couple of things which are at play. One is the technicality of the MSCI weightages. So, when it's below a certain threshold, what happens is that the weightage of HDFC Bank goes up. But next quarter, if the weightage is in accordance with them, the allocation in accordance with the MSCI, then the weightage comes down. So we are going to see these kind of fluctuations happen when the flows come in and go. Having said that, if you look at the performance, they've done a remarkable job of managing NIM. Second thing is, NIM growth will still take a while. I think more important is to get the deposit mix right. The CASA ratios have just not coming in because there are pressures from the market as well as the fixed deposits which are attracting very attractive rates. Also, there are certain banks which give you very premium deposit rates. So, getting the rates back is a challenge. And while they have tweaked their lending yields and managed the NIMs, you can't continue to do that for a very long time because, your asset quality may suffer. So keeping all these things in mind, I think, it's still a wait and watch on HDFC Bank, more of a trading play. And we need to see that they will take at least another couple of quarters before they get it right.
All right, fair point. Let's start off with the queries. The first one is on IRCTC. The question is from Vijay. They bought the counter at a price of 942 rupees. It's currently trading above that price. Vineet, we've seen about 15% upside in this year and something like an IRCTC. For somebody who's holding at lower levels, would you suggest that they should continue holding on to it? How does it look fundamentally from a longer term perspective?
So I think, they run the monopoly on the railways, and with the way the government is modernizing the railways, the experience of airports coming back to the railway stations, I think we are going to see railways which are already well housed, capacities are high. We're going to see better quality of passengers move along railways. And that augurs very well for IRCTC. So not only from passenger traffic, but also from the tie-ups that they're doing with Swiggy, the Zomatos of the world. And so I think, with a lot of Vande Bharats also being added, premium pricing will come in and their profitability is all set to improve with revenues increasing.
Right.
So I'm definitely, this is a good hold, and we think that, this stock over the longer period can touch around 1300-1400 rupees over the next couple of years.
All right, 1300, 1400 in the next couple of years for IRCTC. Vineet, the next question is on Cochin Shipyard. The question is from Raj Kumar, who's writing in from Bangalore. They bought at a price of 2100. We've seen massive rally in not just a Cochin Shipyard, but the whole defense pack. Now, of course, valuations now seem expensive, but they're also getting these large orders consistently. So, what should somebody do? Should you maybe take some profits off the table at this juncture, or should you continue holding on to it because this rally doesn't seem to end?
So, this rally is on the back of very thin market liquidity. So the percentage of the free float is very minimal. And, with this, the speculators have been able to corner the stock and take it up to dizzying heights. It's easier to control the counter. And also the bullish sentiment and the order bookings is helping that. But, we are over a period of time, we are going to see a lot of paper come in the market. And that is a time when, you will see the flip side of this very expensive trades, especially the defense stocks. So my advice would be to take little profits off the table, maintain tight stop losses, and enjoy the ride.
Vineet, is that... Vineet, that is for the whole defense pack you're talking about, or just
Absolutely. Okay. Just for the whole defense pack. But within that, HAL has got a very humongous order book, and so do the other players. But HAL has better margins, better return ratios, and so there, I still think that fundamentally there's a little bit room on the upside of around 5 to 10%. But given that, I think for the entire block, I would be very wary of the valuations.
All right. The next counter is Jindal Saw. The question is from Anand. They bought the counter at a price of 540 rupees. It's not up about 1% in trade, 540, yeah. So a little bit of a profit there for Anand. What's the long-term view on this?
So we like all these saw pipe and pipe manufacturing companies. We're going to see them do very well in the coming quarters, and you can continue to hold on to that stock.
The next counter is Samvardhan Motherson International. This is from a longer term perspective. Beneath auto space, we also looked at the FADA numbers just right before the show actually, and but overall this is an we're talking about an allied services in terms of auto for something like a Motherson. Would you suggest buying at this juncture is the question at the current market price? Is it too expensive at this point?
So it's not expensive. It has got good legs of growth, and it can get continuously re-rated. But during the short term, if you're really looking to buy into this stock, I think buying on dips would be a better strategy. And you continue to hold on to this stock. So, what we like about this complete story is the fact that, it's a story of mergers and acquisitions. And these acquisitions are led by the clients who, instruct Samvardhan to go and pick up a particular asset which is available dirt cheap, given the fact that they believe very strongly in Samvardhan's ability to turn it around. And, you can see from the number of subsidiaries that they have, and they're all global, across geographies, across dialects, and they've been managed to pull off each and every subsidiary that they've taken over into profitable ventures. So they get assured supply from their clients, and they get very stressed assets which they're able to turn around and add value. So I think great company, good portfolio pick, but right now a hold and buy on declines.
Buy-on declines on Samvardhan. Let's talk about Adani Total Gas. I'm not sure of the name of the person who's writing in. Viewers, please mention your name while you send us your questions. Okay, this one's from Mahindra. And the question was on Adani Total Gas. If you can pull up the chart, okay, it's not doing too well today. In fact, it's not been doing well for a while, Vineet. It's been months that the stock has given negative returns. But from a longer term perspective, somebody who wants to maybe buy the counter, would you suggest getting into gas stocks at this point?
Gas stocks are a great buy, but they are also structurally impacted by prices of the natural gas. And we expect natural prices to pick up going ahead over the next few months. So having said that, Adani Total, we do not see too much of upside from here. And we would ask you to switch. And if you want to be present in the gas space, I think GAIL is a better play because it is agnostic to gas prices.
All right.
Significantly agnostic.
All right. It's time to slip into a short break, but we'll be back and we'll take more questions on the other side, and hopefully we'll be joined by Rajat as well. Stay tuned.
Specific PIN codes are not basically given insurance. Specific occupations are not provided insurance. People who do not have educational qualifications, undergraduate, are not provided insurance. So in short, term insurance is a very elite product for a country like India. Right?
Okay.
If you look at the percentage of people, when you cut down all these cuts, like when you put all these cuts into picture, it will not be even 1% of the population of India.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Stock selection isn't an easy task.
And neither is choosing the right moment to sell.
Whether it's a doubt about a short-term trade
Or a long-term investment.
All you have to do
is ask Profit.
Welcome back. You're watching Ask Profit on NDTV Profit. We were in the middle of taking queries, and the next one is RVNL, a doubler in the last 6 months. Vineet, The stock has seen a massive rally, and I know you've spoken about railways, but let's talk about this specific counter. Now, the question is from Sushila, who bought the counter at a price of 156 rupees. It's currently, wow, very close to 450 rupees. For somebody who's had these profits in, would you suggest booking some profits, or would you suggest waiting? Because we're getting, there's constant news flow around these counters on order wins as well.
So I think, when the story is absolutely cheerful is the time when you take some profits off the table. And since she's sitting on a multi-bagger return, I would recommend selling half and keeping the rest of the half with a tight stop loss of around 400 rupees. I think great stories, but I think, they've outlived their fundamentals, or they've, run up too far too fast. So I expect some kind of correction happening out.
All right, fair point. Let's talk about another counter, ITC. This one's from Balakrishna. While they're asking for a short-term view, we'll take a slightly longer-term view on an ITC. Vineet, it has done fairly well as compared to other FMCG players, right? Are you constructive on an ITC? We've seen that stock rally play out already in the counter.
So, we are seeing recently some, slight corrections, lethargy in the performance of the company. Also, their demerger play announced a year back is still to see the light of day. So, my view would be to, buy at better valuations on the stock. This typically is a defensive counter which, moves against the market, and especially when the markets are down, it's a very good hiding place. So I would not recommend buying this stock currently. I think levels of around 400 are better to look at buying those.
Let's take a short-term view on this one. We have Rajat Bose back with us. Rajat, we are talking about the counter ITC, and Vineet is suggesting buying around 400 levels. Is that your view as well?
400 level means that your risk is much less, and what I would say is that if you buy ITC around those levels, you can expect it to climb back once again at least to 440. ITC will continue to remain range bound because you see in 2022 it was below 200, and then it went up to post a high of 499.70. When such a move happens within a short span of time, the next few months or could be a couple of years or so, it will continue to remain range bound. So in range bound stocks, you actually enter at a major support level, then you are much better off in terms of your probability of making money.
Got it. The next one is PSP Projects, Rajat. This one's from Brigu from Punjab, who bought it at levels of 780 rupees. So elevated levels for the counter. Their time span is 6 to 18 months. Do you have a target on this counter? It's not done too well, at least in the last 6 months, given negative returns. Even in a year, down about 6.5%.
PSB projects needs to take out the level of 700. Why that is important? Because the 200-day exponential moving average, which is still moving down, that would be crossed because that is now languishing around, say, 700 levels. Once this level is decisively cleared, you can expect a move towards 728 to about 745. This range, once taken out, that is 725 to about 745, then you can expect it to gain traction. But as of now, what it shows is that some accumulation is happening, but we cannot say, looking at the chart, that all the supplies have been absorbed as yet.
The next counter is CCL Products. The question is from Sandeep. Vineet, coming to you on this one, while this is a small cap counter, would you have coverage on this? Because I think in the last quarterly results, they talked about volume growth of about 20%.
So, we are expecting coffee prices to come off a bit. and given that, I think they should do relatively better because they are more into selling branded products, and they've guided well. So we think that this stock can be accumulated at current levels.
Got it. The next question is from Hari Om, who's talking about Bharat Dynamics. And Rajat, I'll come to you on this one. We've discussed the defense space with Vineet in quite detail. But let's talk about the specific counter bought at 1,652 levels by Hari Om. It's currently trading above that price. And what a run-up we have seen in the defense space. Would you suggest maybe booking some profits? How does it look from a short to medium term perspective on the charts?
In short to medium term perspective, it could still move up from here, but then this move has been pretty much ballistic right from say last year October to current date. That would, at that point of time, it was around 450. Now it is almost 4 times 1750. So if I were in his shoes, I would have booked part profits and use stop losses to protect my profit. And the stop loss as of now should be placed somewhere around 1700.
Got it. Rajat, the next question is on Suzlon. A very similar story. If somebody who bought at extremely lower levels now sitting on massive profits. We have a question coming in on Suzlon from Supriya, and the question is, what's the short to medium term play for something like a Suzlon, up about 4% right now?
See, again, this stock, if you look at it, just see, it started its journey from, say, about 8 rupees 50 paisa last year. Last year, May, late May, early June. From there, now it is already 7 times. It can still move up, but then one should put a stop loss below 48 and continue so long as this momentum carries on. But this kind of a momentum means that there would be some sharp fall like you have seen in HDFC Bank, which as of now looks pretty weak, and similar kind of weakness will be seen wherever the moves have been balanced.
Got it. Thank you so much, Vineet and Rajat, for joining us on the show today. Unfortunately, we're completely out of time in this edition of Ask Profit. And viewers, thanks for tuning in. Hopefully, the questions we asked today were helpful to you. But don't go anywhere. We have lots more lined up for you on NDTV Profit. Stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Hashtag like handwoven or handmade in India or textile made by hand or craft clusters or hand block printing, it's become a marketing gimmick as well. It's very easy to create a story without having the actual backend to support it. So I think in this kind of a space, when when there's a huge interest in what is created by hand and actual artisanal products, we should have some checks in place so that when somebody says that this is khadi, it should be a khadi, and when we are talking about hand block printing, it should be a hand block printing and not a digital print being passed as a hand block printed.
The good part of growth assets is that the more you have,
the better your choices are, right? So nothing like money in the bank to sleep well at night, whether it's a medical emergency or that cruise you want to take. I think gone are the days where we think about a simple life in, a rural community. People want vibrant post-retirement lives with travel, with socializing with friends. Maybe you eat out a few times less, but should you see the Eiffel Tower while you can? I think you should. Asset allocation will change as you age, but certainly you need growth assets in your portfolio. You have a great year, you withdraw it, you go for a cruise on the Riviera. I mean, that's life, right? Most parents would like to leave something for their children, but I think that should just be a byproduct of what's left after you've done everything that you choose to do.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV.
Hello and welcome. This is Hot Money. I'm Agam Vakil, and in this show we take you through all the stocks and themes which are buzzing in trade. But before that, we are looking at the markets which are actually looking at a little bit of recovery of sorts. Now, the Nifty is nearly in the green. It hasn't gone into the green yet, but it is nearly there. It is now marginally lower. And as far as the Bank Nifty is concerned, a little bit of recovery, but it's still down by as much as 1%. So not as much recovery for the Bank Nifty, and perhaps on expected lines because the HDFC Bank is weighing down on all the key indices. Let's take a look at the key contributors as far as the benchmark is concerned and see where there's a pull coming through. Well, we know where the pull is coming from, isn't it? About 123 odd points contributed on the declines as far as HDFC Bank is concerned. That's nearly almost all the 155 odd points coming in. And say for that, we don't have too much in terms of weaker counters. Reliance Industries, L&T, ONGC and SBI, on the other hand, doing whatever they can to keep the Nifty higher at the moment and giving and contributing to that 130-point advance as far as today is concerned. Let's take a look at the broader markets too and see how they are doing at the moment. So the mid-cap index is outperforming, clearly up as much as 0.5%. The small cap index is up even higher by around 0.8%. And in the broader markets, what we are keeping an eye on is Raymond. That's up a whopping 17% at the moment. So a lot of gains coming in there. BEML is the other one from the defense space, which is doing well. Actually, it's essentially a lot of counters from the defense which are in fact up and about as well. So we also have data patterns from the sector, which is also up around 9.5%. Not to discount the kind of gains that we've seen, the tremendous gains that we've seen in something like a Cochin Shipyard or a Garden Reach Shipbuilders as well. Well, we do have, something like even MTAR Technologies, which is actually picking up steam at the moment. Besides that, Blue Star, CG Power and RVNL are among the others which are actually up and about in trade. So we still do have plenty of gainers, even though the benchmarks may not reflect that. In fact, the advanced decline ratio in the broader markets is, well, I would say it's nearly about 11-12 stocks for the advance, as against about 8 to 9 stocks on the declines. On the NSE 500 itself, we're about 3 gainers for 2 losers. Talking about the losers, very quickly, let's mention a little bit of weakness here in MedPlus Health, that's down 3%. AstraZeneca, that's down around 2.8%, and Rainbow Children. But do note that, these decliners are not looking at tremendous amount of losses. Certainly not as compared to the kind of gains that the advancing companies are, well, indicating at the moment. But with that, let's take a look at all the stocks that we want to address in the show today. Well, naturally, we're going to talk about HDFC Bank with the update that we've seen come through. Raymond as well, because of the demerger news. We want to talk about railway stocks as well as the capital goods sector. And we're also going to take up Mahindra Life Spices along with the defense sector. And to take us through all this, well, we are in conversation with Gaurang Shah. He is the head of investment and strategist at Geojit Financial Services, who's joining us on the show. Gaurang, good afternoon. Thanks for taking the time out. Gaurang, before I come to you, let me take up HDFC Bank. Well, we have Harsh who's joining us to give us the latest quarterly update on how things have fared. Harsh, over to you.
Well, yeah, absolutely. So to kind of contextualize this first off, absolutely flat from a deposit growth perspective, 0% growth. But you saw Q4 FY24 at 7.5% sequential growth, which was extremely strong. So it was a higher base, of course. They've been able to maintain that at 0% now. So not really growing at all in Q1 FY25. And the real concern is with regard to loans though. So you're looking at loan growth, which is minus 0.8% on a sequential basis. And in Q4 FY24 as well, it was just about 1.6%. So essentially, the growth over 2 quarters is less than 1%, which is abysmally low. Of course, reasons for that, management commentary awaited, which will likely come out post the results on the 20th of July. So that will be awaited and keenly awaited. But just in terms of what's not doing well, wholesale is not doing well, and retail, they are ceding market share as well. Retail loan growth not really picking up in the way it ought to for HDFC Bank. It's also a bit of a conscious calibration with regard to bringing down that loan to deposit ratio, in likely to try and focus in on margins as well as profitability. And that will be the key pieces which will turn things around. One is your loan to deposit ratio needs to come below the 100% mark, which is currently at 105. Margins need to go up from the 3.5% all the way to 4%. And you need to start seeing EPS growth. So likely the street not anticipating too much of that in this quarter at least.
Okay, Harsh, thank you so much for getting us those updates on HDFC Bank. Gaurang, you know, after a disastrous third quarter and the kind of reaction that we saw in HDFC Bank, and then the Q4 earnings came in, and it did seem like things were turning a corner for HDFC Bank. Now it seems like it's yet another subdued quarter coming in, though a seasonally weak one. What is your assessment on this one, and how would you go about this?
Good afternoon, and thank you for having me on the show. So, you know, HDFC Bank is a bank wherein you don't look at 1-2 quarters, you look at year on year, and more effectively, if you have a decisive long-term time horizon, then it's always prudent to look at longish growth opportunities that lie. And if I have to even look at the last 3 years, 5 years, 6 years, 10 years performance of HDFC Bank in terms of numbers, or even otherwise in terms of return on investment for an investor, then I don't think this bank has disappointed long-term investors. We have been maintaining a positive coverage on HDFC Bank for a pretty long period of time, and I'm sure we are going to continue to do that for the longest future to come by. You know, merger that happened with HDFC Limited into HDFC Bank, and then the kind of synergies which were likely to evolve. Not to forget, all of us were extremely upbeat when the merger was going to go through. And then, of course, we had concerns on the margin front and a slightly disappointment in terms of certain loan books exposure going up and the margins getting squeezed. But I don't think that these kind of short-term overhangs should have any kind of decisive impact on your long-term investment. So we are quite optimistic about the bank's performance over the next couple of quarters and financial years. And hence, we are maintaining a buy call on HDFC Bank. Short term, there can be small hurdles, but long term, I think the stock is quite well placed to deliver.
Right. Well, there you have it. That's the view on a focus, HDFC Bank, pardon me. In the long run, positive. Gaurang remains positive. Let's move and talk about Raymond. Now, this one has announced, a demerger of its realty business. And well, on the back of that, we actually have a sharp up move around 15.5% just in today's day of trade. Let's get in my colleague Mahima to tell us more about the plans. Pardon me, rather my colleague Mahima did speak to the CFO of the company, Amit Agarwal, on the possible synergies from the demerger and more. This is a slice of that conversation. Listen in.
I think it is very, very clear path for the Raymond Group to unlock value for the shareholders. And if you see in that step, when the business matures up to a certain level, then we want to show to the world that it is a pure play, net debt free listed business. As we have demonstrated that we did the lifestyle business last year after the sale of the FMCG and making it a net debt free listed business on a pure play basis, which is getting the book record date is happening on the 11th. So everything is done. Now, as we have scaled up in the real estate business, and this was the philosophy very, very clearly underlaid that we will have the businesses which will have a standing on its own feet, and then we would do a pure play businesses. And as we delivered 1,600 crore plus revenues in the business, 370 crore EBITDA, and 2,400 crore of bookings. And as we speak today, this company is not just focused only on the Thane development, which is the own land. However, it has gone beyond Thane. And we have signed the four JDAs, which amounts to almost 7,500 crores. So if I look at it as a business, we have got a right mix and not focused only on Thane land. So together, we see a scalable, and any demerger takes anything between 14 to 16 months. So we believe by that time, when the demerger really goes into effect, this company has reached, and today itself, it is one of the top 5 builders in the MMR region. And I think that is an opportune time.
Okay, so that's the management, that rather the CFO of Raymond talking to us about the demerger and what it may mean for the realty business going forward, and talking about more than just Thane and in terms of the various different other announcements that they've made in Bandra as well as Worli. But Gaurang, if you can come in on this one, your stance on this on Raymond and how they are going about the demerger, your view on the business minus the realty business, as well as whether or not you would in fact look at holding on to the real estate business once one would be allocated those shares.
So I think first it's prudent on our part to give a disclosure. We've been maintaining a fundamental positive approach on Raymond's from a long-term point of view, and it has been under our coverage for a pretty long period of time. Murmurs of these demerger was on the street to a certain extent because the stock was in spotlight not only this week but even last week, and that's the reason why we've seen these kind of elevated levels. One share of the demerged entity to be given to existing single shareholder of Raymond's Limited. Opportunity in terms of not only the Thane land bank parcel that they have, but also in other MMRDA areas like Bandra East, I'm not mistaken, there is an opportunity for them, and they have already announced that, and many more opportunities to come by. Now the thing is, we know that one will get one share of the new business for one share held of Raymond Limited, but what I don't have clarity about is the valuation process of this entire demerger and the timeline as to when it is going to happen. But the fact of the matter is that real estate sector as such has been in the spotlight for all the good reasons. Month of June, we saw in excess of more than 11,000 registrations coming through, which is a historical number over the past decade, if I'm not mistaken. And I think if the company is going to go in the right direction where the opportunity lies, then the new business is also going to get scaled upwards. But we'll have to wait for that to happen at ground level. But overall, on the standalone business of Raymond's, I think their new launches in form of Linen has seen tremendous amount of traction and attraction from the consumers, and that business also continues to do well.
All right. So that's the way as far as Raymond is concerned. On that note, Gaurang, stay with us. We slip into a short break, and on the other side, we continue the discussion around stocks we have on our radar. Back in just a bit.
hashtag like hand woven or handmade in India or textile made by hand or craft clusters or hand block printing, it's become a marketing gimmick as well. It's very easy to create a story without having the actual backend to support it. So I think in this kind of a space, when when there's a huge interest in what is created by hand and actual artisanal products, we should have some checks in place so that when somebody says that this is khadi, it should be a khadi, and when we are talking about hand block printing, it should be a hand block printing and not a digital print being passed as a hand block printed.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Specific PIN codes are not basically given insurance. Specific occupations are not provided insurance. People who do not have educational qualifications, undergraduate, are not provided insurance. So in short, term insurance is a very elite product for a country like India, right?
Okay.
If